Welcome, everyone, to the 2024 Carter's Fasken Healthcare Philanthropy webinar. We're delighted that you've joined us here today. We have many attendees that have joined, and we're really looking forward to a great morning together. My name is Terrance Carter, and I'm the managing partner of Carter's. And I'm going to be one of your co-moderators along with Lynne Golding, who is a partner at Fasken's. You know, we've been doing these healthcare webinars and seminars now for about 20 years. The two firms have been working together because we have a close working relationship in the charity area as well as in the healthcare area as well. Fasken's is a national firm with many offices across Canada, one of the largest law firms in Canada, and are leaders in the healthcare area. And I have the privilege of acting as counsel on charitable matters to the Toronto office of Fasken's. Carter's is not as large as Fasken's, not yet, but we're getting there. And we're what we believe we're one of the leading firms in Canada in the area of charity and not-for-profit law. So together, we think we put together a pretty good package for you of resources. And in that regard, we do have newsletters that are put out by the two law firms. Just encourage you, if you want to receive the newsletters, there will be a slide during the break time where you can connect and sign up for the two firm newsletters that come out on a regular basis. The purpose of the webinar today is to provide you with a good sampling of some of the key current issues that healthcare charities and foundations are facing in Canada with the change in the law. And I wonder if, Joyce, if you could just pull up the slide with the agenda for the day. I'll just go over that briefly with you. We've coordinated matters so that it'll flow pretty well. Lynne's going to start off with some of the changes on the ONCA, and then Theresa L.M. going to talk about the disbursement quota. Each of the sessions are about 30 minutes and will include questions as well. And then we're going to have a presentation by Corina Weigl on receding challenges, and a 10-minute break. Come back, and I'm going to do a presentation on the new qualifying disbursement regime, which is a bit of a challenge. And then we'll go into gift acceptance policies for healthcare charities. And we'll end off with Jackie Demczur doing a presentation on our really key developing area being the donor-advised funds for healthcare charities. So we think we've got a good flow for the day. The slides are going to be very content-rich because we wanted to provide resource tools for you going forward. Questions are going to be dealt with at the end of each session, so there is a Q&A a button, which Lynne will talk about in a minute, that you can ask your questions. And so at this point, I want to introduce you to Lynne Golding, who is a partner at Fasken's and co-lead of the Fasken Health Law Group and practice primarily in the health sector. Lynne, great to be working with you today on this webinar, and you'll give us some details, and then Lynne's going to go into her presentation dealing with ONCA transitioning issues. Lynne.
Thank you very much, Terry. And let me also welcome everyone here today and reiterate how wonderful the relationship is that Fasken has with Carter's. It's nice that we both have the resources of each other's firms to bring to the benefit of our clients. So just a couple of housekeeping matters for you. You will have received an email setting this out. But in case you've missed it, the session is being recorded. We hope you'll stay here right to the very end. But if you're not able to, you will be getting a link after this session to the materials that have been presented and as well to the video. So you could finish watching it later or watch it again in rerun if that's your preference. If you have questions, you'll see that there is a chat button, and underneath the chat, there's a place for questions. So please put them there. And if you have any tech issues, there's also a button there. Just submit them, and someone on our tech team will make sure that you can see and hear everything that we're presenting. At the end of the session as well, there'll be a short survey. This too will be sent to you in the link, and we really appreciate you filling that in. And do let us know if there are any other topics you would like us to address in this seminar in 2025. So with that, we'll go to my presentation. Joyce, you can advance the slide, please. So I'm going to be talking about lessons that we've learned from the ONCA. It's been in effect for about 2.5 years now. And so we've had an opportunity to delve into a few issues, and I just want to go over some of our findings from that. And you will know as well that the Act was amended in October of last year, just a few tweaks, and we'll talk about some of those too. So we can go to the next slide, please, and the next slide. And the next slide, we're going to talk about electronic voting and electronic attendance. So you'll recognize, if you're an Ontario corporation, you'll recognize this definition of telephonic or electronic means. It's been in the Act for the past 2.5 years. We've been living with this. And this is the concept. This definition is relevant for the calling of meetings, whether it's board meetings or members' meetings, and for voting at the meetings. You can see that it includes participating by telephone calls and emails, and we've had a new addition to the definition in October of voicemail. Now, this is a very broad definition, but it doesn't mean that you can use this for every single purpose, as we will see. Parts of it will be applicable to some purposes and not others. So we can go to the next slide, please. So let's start with members' meetings. So unless your articles or bylaws provide otherwise, then you can have your members' meetings electronically, by telephone or computer means, or in person, or any combination of those. A new addition to the Act as of last October is a requirement that if you are going to have members be able to participate in your members' meetings virtually, then your notice of meeting has to include instructions for how they would participate in that meeting, and if there's going to be voting, as to how they would vote. So your notice of meeting will say something like, we're going to be attending this meeting by Teams or by Zoom, and you will be able to vote using the voting buttons on those platforms, if indeed that's how you are participating. We can go to the next slide. You may remember that when the Act first came out, it had this language that was intended to provide for confidentiality in voting, and also to ensure that only people who were members or proxies were able to vote. The really hard part of it was the part that said that the corporation itself was not able, had to have a system in place so that it could not tell how a member voted on a particular matter. Now, this is kind of hard because it really meant that you needed to hire a third-party provider to be involved in the holding of meetings. Fortunately, we never really had to deal with it because, as soon as the Act came into effect, we were in COVID, and we had this regulation in place that said we didn't have to worry about that during this COVID period. Well, that regulation that gave us that relief has since been repealed, but at the same time, so was that provision. So now you will be able to hold a meeting electronically or by telephonic means or in combination with people attending by person, and there's no requirement that the corporation have this secret process in place. So let's go to the next slide, please. Now, in terms of the standard for people being able to participate in these meetings, for many, many years, the standard for attending meetings by telephone or other means was that everyone had to be able to communicate adequately with each other during the meeting. That was the standard, adequately. In October, this language was changed for both members and directors' meetings. And the standard now, as you can see, for members' meetings is that people must be able to attend the meeting and be able to reasonably participate. Reasonably participate. Now, I don't know what those words mean, but they're different than communicating adequately and possibly to a lower standard. We will see how those words come to be interpreted. And if we can go to the next slide, we have the language for attending meetings of directors virtually. And here again, we have a different standard. Again, it's no longer being able to communicate adequately. Here it means that you must be able to communicate with each other simultaneously and instantaneously. So again, we're going to have to see how these words come to be interpreted, but I can tell you flat out, voting by voicemail, which you may remember was added to the definition of electronic and telephonic, that will not meet this test. You will not be able to vote by vote by voicemail and meet a test of simultaneous and instantaneous communication. Okay, we can go to the next slide, please. So now I'm going to speak about the notion of casting votes. And here I want to distinguish between two types of casting votes. I'm talking about when the chair of a meeting has a casting vote. Historically, old bylaws will refer to something called a second and casting vote. And what that meant was that if there was a tie, then after the chair voted the first time, the chair could vote a second time to break the tie. So that's what I mean by a second and casting vote. And I distinguished that between a situation where a director is a chair and is only voting once as a casting vote. And for the purpose of this seminar, I'm going to call that a first and casting vote, although you'll never see that in bylaws. It'll just be referred to simply as a casting vote. But looking at a second and casting vote, which, as I say, you will see in some old bylaws, there are some provisions that need to be considered when you are next amending your bylaws, if you still have those provisions. So let's go to the next slide, please. Under the ONCA, all members are entitled to only one vote unless the articles provide otherwise. Now, they might provide otherwise because perhaps directors have different numbers or other members have different numbers of votes depending on different circumstances. But if your organization is one where every member is only entitled to one vote, you don't need to provide for that in your articles. But if you want to give your chair the right to exercise a second and casting vote in the event of a tie, you do need to provide for that in your articles. Let's go to the next slide. Now, when it comes to board meetings, the ONCA does not speak about the number of votes that a director gets, but at common law, a director is only entitled to one vote. So in our view, a director who's the chair of a board meeting cannot exercise a second and casting vote. You will, however, see that in some old bylaws, and we would suggest that you remove those clauses. So in terms of what you would put in your actual bylaws, we can go to the next slide. If you do want to have this deal with this second and casting vote, you can, as you can see from option 3, explicitly permit it. If you want them to have a second and casting vote, explicitly permit it. But again, if you're doing that for members' meetings, do amend your articles to provide for that. And as I say, at the board table, I would have a hard time giving you an opinion that you had a valid resolution passed if the chair had a second and casting vote at a board meeting. Your bylaws could also explicitly prohibit this, and I would explicitly prohibit it if it has been your practice in the past to allow this and you no longer want to permit it in the future. Do set that out because it's a change in practice and people may wonder about it. But of course, you could just be entirely silent on it, in which case the chair will not have a second and casting vote. Okay, we can go to the next slide. So now I want to talk about the more normal thing, which is what you might refer to as simply as a casting vote or a first and casting vote. So just as a reminder, at law, the chair of a meeting has a right to vote on any resolution if they are otherwise qualified to vote. So at a board meeting, the chair of the board will be a director, and the chair has an absolute right to vote. And at a members' meeting, if the chair is a voting member, the chair has a right to vote there. But often chairs don't vote, right? Often chairs call the vote and they say those in favor, those against, and they determine what the conclusion is. And they don't, in fact, vote themselves. But they could vote, and particularly where there is a tie, to break the tie. Sometimes bylaws are very explicit about this. And we can go to the next slide, please. And they say explicitly that the chair will only vote in the event of a tie. And that's fine. You can provide for that if you like. Or you can be silent, which means that the chair will vote or not vote as they like depending on whether they feel the need to and whether there's a tie. Now, at a board meeting, do keep in mind that every director is entitled to dissent rights. They're entitled to have recorded in the minutes that they voted against a matter if they were at the meeting. And if they weren't at the meeting and they later find out about a resolution that was passed and they disagree with it, they have a certain number of days to notify the Secretary of the Corporation that they were not in favor of it. So board chairs, if you're chairing a meeting and you're not voting, but you disagree with how a vote has been determined, you should ask the secretary to record it in the minutes that you did not approve it. You should vote against it and have that recorded. Okay, so now we will go to proxy voting on the next slide, please. And we'll skip to the next slide and then the next slide. So just as a reminder, under the Ontario Corporations Act, it was required that a corporation would permit members to vote by proxy. And a member was entitled to appoint anyone they wanted as a proxy holder. It didn't need to be another member of the organization. It could be a complete stranger, the organization, your own family member or your neighbor if you wanted. This is all changed under the ONCA. Under the ONCA, as a corporation, you do not have to permit people to vote by proxy. And if you do want to permit them to vote by proxy because you've provided for that in your bylaws, you can limit who will hold those proxies to people who are members. In terms of other requirements, it's kind of ironic that under the old regime where you had to permit proxies, there really weren't very many rules about the proxies. There was a rule that said that if a corporation set a time limit for when it was going to receive proxies, then that time limit couldn't be more than 48 hours before the meeting, and you didn't include Saturdays and holidays in that calculation. And that concept is carried over into the ONCA. But as I say, there were hardly any provisions in the old act about what a proxy would look like. And so we can go to the next slide, please. Proxies could be very simple. They could pretty much say, this is a proxy for, and here's the meeting we're talking about. And you could say, I appoint so-and-so can vote at the meeting however they like. It didn't have to be specific. That was under the old statute. Now, under the new statute, we can go to the next slide, there are a lot of requirements for proxies, so be very careful when you're completing a proxy. Look very carefully at the regulations because it talks about certain things that have to be in bold-face type. It talks about how if you appoint one person, you need to have a provision there for an alternate to be appointed. It talks about the things that have to be recorded as being voted for or being withheld. So, for example, if a proxy is for an annual meeting and it talks about the appointment of an auditor, the choice for the person completing the proxy is to instruct the proxy holder to vote for or to withhold from voting. And the same is true for the election of directors. You instruct your proxy holder to vote for the people indicated or to withhold your vote. For all other votes, though, the choice would be vote for or against. And so here's an example on the next slide of what the proxy looks like these days. A lot more complicated, things in bold, and different questions depending on whether it's an election of officers or an appointment of auditor or otherwise. We can go to the next slide, please. So now I want to talk about audit committees. Just as a reminder, as corporations under the ONCA, there's no requirement for you to have an audit committee. But if you do have one, there are a few provisions that have to be complied with. So we can go to the next slide, please. So first of all, there is an absolute function for the audit committee. If you have one, they are to review the financial statements of the corporation before they are approved by the directors. And of course, it's expected that they will do a much deeper dive into the financial statements, and the board is entitled to recognize that the audit committee has done so before they come to the board. For directors and officers, you have a duty, if an audit committee exists, to bring to the attention of the audit committee any errors or misstatements you see in the financial statements. And if you have an audit committee, there's a requirement about who is to be on it. Now, for some time, it has been the case that a majority of the audit committee has to be comprised of people who are not officers or employees of the corporation or any of its affiliates. That's the language in blue down there. That's not new. It's been there for the past 2.5 years. It's a bit hard sometimes for charities to meet that requirement, particularly if you have a group of charities that has together formed a common audit committee, like you might if you have a foundation and a hospital and a research institute, because you might want your board chairs on there. Well, they're included in that group of officers that cannot form a majority of the committee. But the test has become even harder now because under the amendments that were just put in place in October, your audit committee can only be comprised of directors of the corporation. Directors of the corporation. And this is hard because often charities don't have the necessary skill set for that on the board. They're calling on community members to supplement the membership of the audit committee. So there are a few potential solutions to that. We can go to the next slide, please. One is to, if you can't meet those requirements, then eliminate your audit committee. And if you have a finance committee, you can put some, not all, some of those functions into the finance committee. But the finance committee would very much have to be acting in an advisory committee on many of those functions. If you have a finance committee, they cannot be the ones, therefore, that are recommending to the board the approval of the financial statements. The board itself will have to undertake the review that an audit committee would have otherwise. Another option is to create the audit committee that is comprised only of directors and so meets the requirements of the Act, but then supplement that committee with advisors. Those people from the community that you would otherwise have had on your audit committee, invite them to participate as advisors. They can speak, but they won't be able to vote. Okay, we can go to the next slide, please, which is about cross-appointed or overlapping directors. And I'm going to speak in particular here about hospitals and foundations, but other healthcare charities may have other related charities that this is relevant for as well. Now, what I'm talking about here is where you might have a hospital CEO and board chair sitting on the foundation board, and perhaps the foundation chair sitting on the hospital board. That's what I mean by cross-appointed or overlapping directors. We can go to the next slide, please. We know that foundations and hospitals or other charitable organizations have a really symbiotic relationship. They need each other to be successful. And so it's really important that they're able to contribute to each other's strategic and annual plans and to understand each other's priorities, their opportunities and challenges. And historically, one of the ways that this need has been met is by having those crossover or appointed overlapping directors. These days, I'm finding that this is creating a lot of tension between foundations and hospitals. And there are a few reasons for this. And one of this relates to the changes to the ONCA. So we can go to the next change, please. Next slide, please. So the ONCA defines a conflict of interest more broadly than the Ontario Corporations Act did. For one thing, it includes both directors and officers. And for another thing, it defines within this conflict of interest a situation where the corporation is entering into a material contract or a material transaction with another corporation, and where there are these overlapping or cross-appointed directors. And if that's the case, then a conflict is deemed to exist, and the conflicted directors can't attend the meeting where those matters are being discussed, and they can't vote on those resolutions. We can go to the next slide, please. Now, people are thinking that this applies to a great many matters that are being discussed by the boards. In fact, it relates to material contracts and material transactions. So let's give some examples. As a foundation, you might have a services agreement with the hospital where the hospitals are providing you with premises or IT or other back office services. That is definitely a material transaction to the foundation. May or may not be material to the hospital when it's approved at the hospital level, but for sure at the foundation level. So cross-appointed directors and officers would not be able to participate in that discussion at the foundation level. Now, what about a grant of funds from the foundation to the charitable organization? In my view, that is a contract or a transaction, and it for sure is material to the foundation, and it is very likely material to the hospital as well. So cross-appointed directors shouldn't be voting on those resolutions. But what about the creation of an annual budget or a strategic plan? That's not a material contract and it's not a material transaction. So in my view, these provisions of the ONCA would not be engaged for resolutions of that nature. Cross-appointed directors and officers could vote on those matters. Now, this is not to say that cross-appointed directors and officers are not subject to their normal fiduciary duty. They, of course, have to act in accordance with the best interests of the corporation that they are at the board table of. And if they find that they're not able to do so because of their other fiduciary duties, they should abstain. They should not participate in that discussion. And also, of course, your bylaws or your policies may have procedures that are broader than what is in the ONCA. I want to talk for a minute, we can go to the next slide, about the Charities Accounting Act and the regulation to it that deals with payments that are made by a charity to its directors or to people or corporations that are related to that director. This bylaw, or rather this regulation, is quite long. And it's quite complicated. And I'm only going to deal with this one aspect of it. And that is the case where a director of a charity like the foundation has these cross-appointed directors, like, the chair of the board of the hospital. The cross-appointed director from an organization that is going to receive money from the foundation has somebody on the foundation's board who is another director. I call that kind of an ordinary connection, but another circumstance could exist where that foundation has on its board the CEO of the hospital. The CEO is an employee of the entity who is going to receive money from the foundation. And I call that an extraordinary connection. You won't see these words in this regulation. I'm just using them for the purpose of this presentation. So where, in my example here, the foundation is going to pay money to the hospital for goods or services or facilities, then this regulation is engaged. We can go to the next slide. Where the payment is made to the hospital and the foundation has on its board cross-appointed or overlapping directors who are not employees of the hospital, then to make the payment, the foundation just needs to be confident that making the payment is in the charity's best interests and that the amount being paid for the goods, services, or facilities under that services agreement that I spoke about earlier are reasonable. Going to the next slide, please. But in the case where you have an employee of the hospital on your board, then this is an extraordinary connection. And there are many more criteria that have to be made, that have to be satisfied before that payment for goods or services or facilities can be made. For one thing, the board is going to have to set an upper limit on the amount that can be paid to the hospital. The foundation will have to do that. Every director of the foundation is going to have to agree that the amounts to be paid are reasonable and that the other requirements of the regulation are made. And the foundation is going to have to include in its financial statements a note that this payment has been made to a related entity, a connected entity, and is going to have to disclose that to its members at the annual meeting. Also, no one connected to those conflicted directors can vote on those resolutions or matters. And we can go to the next slide, please. And the next slide. There are some payments that are to be made, that could be made to a director, but they cannot be made based on these provisions. You'll need a court order for them. And that includes a circumstance where you're paying a director who is also an employee of the corporation. All right, I'm just about to wrap up. We're going to go to the next slide, please. And then the next slide. And the next slide. So just as a reminder, the transition period for the ONCA will be up on October 19th. So on October 19th of this year, if you have not amended your bylaw to be in compliance with the ONCA, it will be deemed to be in compliance. And that's going to be really confusing for you. So by all means, if you have not yet done so, move to adopt bylaws that are in compliance with the Act. I've said here there are a few provisions of your bylaw that if they were in effect on October 19th, 2021, they will not be deemed to have been amended, but they are likely a small portion of your bylaws. Let's go to the next slide, please. And finally, just to talk about the transition process, we talk about what's optimal. If you want to do the optimal, which is that you really take a look at your bylaws right now and you do a little bit of a governance review, you look at your letters pat, and you say, are there big picture things that we should be changing in order to bring our bylaws into compliance with our current practices, best practices, as well as the Act? You might want to engage in a more thorough review, but you better get started on it now. But at a minimum, before October, do move to amend your bylaws, adopt articles if required, get your board and members to approve, and file your articles of amendment if required. Okay, I am now done my presentation, and I'm happy to take any questions.
And Lynne, I'll let you just go because with your presentation, because there's a lot there. Only one question, are there definitions for directors and officers in the ONCA? If you could just answer that quickly, and we'll get to the next presentation.
Yes, there are. Yes.
That's a great answer.
The Act sets out, the Act does set out, let me tell you, it sets out you need to have directors. It talks about what directors must do. I suppose if you have a bylaw, and sometimes it happens that nobody specifically has that name, the court will find a group that is deemed to be your directors. You might call them trustees, you might call them governors, you might call them something else, but the board will find the people who meet the requirements of the Act that are making the decisions and are called directors. It also specifies that you can have officers. It only requires you to have a board chair. It doesn't require you to have a secretary or a president, but you can have whatever other officers you deem are appropriate.
Great. Thank you very much, Lynne. Comprehensive review of recent changes. Excellent. And we're going to move now to the next presentation. Joyce, if you can advance the slides to Theresa. Theresa Mann is a partner at Carter's and been with the firm for now 24 years and is a charity not-for-profit lawyer and an author. Theresa, we're delighted to have you come and share the ins and outs of the increased disbursement quota.
Good morning. Thank you, Terry. Good morning, everyone. The next 30 minutes or so, I will talk about this wonderful, complicated, confusing world of disbursement quota that went through many changes over the years. Next slide, please. And this shows how complicated it gets. Just an overview, so I'm going to talk about what is the disbursement quota, a bit of a history of how it developed, new changes as of January 1st, 2023, and how do we calculate the DQ obligation, what would go to meeting the DQ obligation, and how to track DQ, especially in the new T3010 that was just released. And then a bit of the related issues like DQ obligation reduction, accumulation, so a bit of the different issues. Next slide, please. So first of all, what is DQ? DQ is a term used in the Income Tax Act, which refers to a minimum amount that a charity must spend on, not everything, it must spend on charitable activities or qualifying disbursements, a new term that we have these days, which includes gifts to qualified donees and grants to non-qualified donees. And the reason why DQ is in the Income Tax Act is to make sure that charities spend at least a minimum amount of its charitable funds for charitable purposes and are not simply accumulated. Today, we particularly would want to highlight that DQ is especially important for charities like foundations and healthcare charities that have investment assets because of the recent changes of the DQ, increasing the DQ rate from 3.5% to 5%. Next slide, please. And this chart shows a bit of a timeline changes. It first came into place in 1976. There are three major changes over the years in 1984, 2004, in 2010. And now, after a lot of consultations and discussions and proposals, we again got new changes effective as of January 1st, 2023 as a result of the 2022 budget from Bill C-32. Next slide, please. And the new changes that we now have as a result of Bill C-32 is the previous 3.5 DQ rate is increased to 5% DQ rate for properties that are over $1 million. So I'm going to talk about that in a bit more detail. And this new 5% DQ rate is effective as of January 1st, 2023. Next slide, please. So this slide have a little table and the box up front. The box up front is the scripture for this morning. This is the DQ rule that we need to work with. For charitable organizations with average value of property, and property at the bottom of the slide means property that is held by a charity that is not used in its directly in its charitable activities or administration. So any of those property that exceeds $100,000 or for foundations that holds average value that exceeds $25,000, then the DQ will apply. So that means charitable organizations and foundations with asset put aside that is below this threshold value, then there's no DQ. They don't need to worry about it. Any asset over that threshold, there's a DQ rate of 3.5% up to $1 million. Any asset putting aside over $1 million, then the DQ rate used to be 3.5, is now 5%. Next slide, please. Then the next two slides, I will talk about how to calculate the DQ obligation. And the rules are set up in the Income Tax Act with details in the regulations, 3700, 3701, and 3702. First of all, we need to look at what property do we look at in order to calculate the DQ. Because DQ, the 3.5%, the 5% does not apply to everything that a charity holds. It only applies to property owned by the charity that is not used directly in charitable activities or administration. So it could be GICs, it could be cash in the bank account, it could be investments, stocks and bonds, mutual funds, even inventory set aside, lands and building that is maybe rented out to another entity to generate revenue. So it could be in different forms, but anything that meets the requirement that is not used directly in charitable activities or administration, then that would be included in calculating the DQ. And usually the sector refers it to the asset base, and this is what I'm going to refer to, the asset base. And also when we have collected all of this property, we look around and see what we own and what the charity put aside. You collect them all, but then there's a deduction. If the charity has obtained permission from CRA before December 31, 2022 to accumulate funds, then that accumulated amount will be deducted from the asset base. I'll talk about the accumulation of property later, but just keep that in mind. That asset is not included. Then we look at the time frame, because there's rules that says if I'm looking at what is my DQ obligation for this year, 2024, then the asset that we need to look at are the asset held by the charity in the previous 24 months. So in the example at the bottom of the slide, if I'm looking at DQ rate for 2022, then assuming it is December 31 fiscal year end, then we look at the asset owned by the charity in 2020 and 2021. Next slide, please. Now, I just explained that if you look at the current fiscal, then we look at the previous 24 months. Then how do we come up with the actual value of the asset to apply the DQ percentage? Because the asset held by a charity, the value may go up and down. You may buy mutual fund and then you may sell funds. You may buy a building now, you rented it out now, but then 6 months later, you take the building back, you use it for the charity. So the Income Tax Act requires the charity to look at everything owned within that 24-month period and then take an average. The average would depend on anywhere between 2 to 8 periods. If you look at the regulations, it looks complicated. So a little table that explains what it is and give you some examples. So, for example, if I'm looking at our current fiscal 2024, assume December 31 is the fiscal year end. So that is the far right-hand column. So the time frame that we need to look at is January 1, 2022 until December 31, 2023. So that's the 24-month period. As I said, investment asset may go back up and down. You may rent the building out. You may take it back, use it on your own. So it becomes used directly for the charity's own activities. Then what do? Then the Income Tax Act, the regulation says you calculate the average value of the asset within that 24-month period in order to calculate the DQ obligation of 2024. So then it talks about 2 periods, 4 periods. What it means is the charity can decide how to do the averaging. The charity can decide to use 2 periods. That means you look at the amount over the 24-month period on an annual basis. So you look at the value as of December 31, 2022. You look at the value as of December 31, 2023. Take an average. The charity can decide to use 4 periods. That means you will look at the value on a semi-annual basis. So you take the 4 numbers, you average it out. You can also choose 8 periods. That means you look at the value on a quarterly basis, and then you average it out over the 8 periods. And the charity can choose whether to use 2, 3, 4, 5, 7, 8 periods, whatever the charity use. Usually charity will choose 2, 4, and 8 because that would be much easier to do the averaging. And once the charity chose the number of period to use, it cannot be changed unless it gets CRA's approval. Then once the charity obtained that average value over the 24-month period using the different valuation, annual, semi-annual, or quarterly, then the charity would apply the 3.5% DQ for asset below $1 million or 5% above $1 million, add them all up. That's the DQ obligation for the fiscal year that the charity would need to meet. Next, please. Then we need to look at, okay, now I've done my DQ calculation. I went through everything, all the number crunching. Then the other side of the equation is the charity will need to decide, am I meeting my DQ obligation? So first of all, only certain expenses can be counted towards meeting the DQ. And those are funds spent by the charity on its own activities or qualifying disbursements made by the charity. And there's some uncertainty in terms of making resources available as part of the qualifying disbursements, whether that would count meeting the DQ. So Terry Carter would talk about qualifying disbursements later today, and he will shed some light on what that means. And that is very important because we need to understand the rules about qualifying disbursements in order to be able to calculate whether the charity meets the DQ obligation. One thing to keep in mind is in meeting the DQ obligation, the expenditure is calculated on a global or charity-wide basis. What it means is that although the DQ obligation is calculated based on the asset base, that means the assets set aside for investment purposes and not used by the charity on its activities or administration. But any expenditure by the charity can be counted towards meeting the DQ. So that means it is possible for a charity, say it has $5 million set aside, and that's the asset base. So it calculates the DQ obligation based on the $5 million. However, the charity has another $10 million or $10 million in asset that it is using on its activities or administration. It could be a building, it could be money in the general operating bank account, money in, money out. Any disbursements, any expenditure over everything owned by the charity can be used in meeting the DQ. So you could actually keep the $5 million untouched as long as it spent enough from its outer asset in meeting the DQ obligation. That is perfectly permitted under the Income Tax Act. Next slide, please. So we understand that every charity, unless charitable organization that owns less than $100,000 or less than $25,000 in investment asset, but everybody else, we need to have a DQ obligation to meet. And then we've talked about how to meet the DQ obligation. And then we need to talk about what if a charity spend more on meeting its DQ or spend less in meeting its DQ. And charity will need to track it. So what it means is DQ excess means in a year, if a charity spends more than what it needs to meet its own DQ obligation, that's like a credit that it can use for a time when the charity has a shortfall. So that means the charity will need to track whether it spend more than what it needs to meet the DQ obligation in a year, keep track of it. Any of those excess can be used to meet DQ obligation in the next 5 years or a DQ shortfall in the previous year. So you can carry forward 5 or carry backward 1. That means on the flip side, if a charity spends less in a year in meeting its DQ obligation, so there's a shortfall, then it will need to look around on how to meet the shortfall. So first of all, it can look back at the last 5 years. If the charity has spent more than what it needed to meet its DQ in the past 5 years, so you can use those DQ excess to apply towards the DQ obligation this year. But then if there's not enough from previous DQ excess or there's no DQ excess in the previous 5 years, then you can spend more in the following 1 year to make it up. So that's why carry forward 5 and back 1, that's how the rule works. But then the problem is continuously having a DQ shortfall may lead to revocation of the charity's charitable status. And then I'll talk about there's one deeming mechanism on DQ reduction that I'll talk about later on in the presentation. Next slide, please. And because the DQ obligation is important, we need to track it. Consistently not meeting DQ may lead to revocation of charitable status. Then it is very important for a charity to track its DQ obligation, and it also needs to report the DQ in its T3010. Way at the beginning of my presentation, there's a flowchart talking about the historic development of the DQ. When the DQ became extremely complicated in 2004, at that time, there's actually a worksheet attached to the T3010 called the DQ worksheet. It's a completely separate schedule to have charity track its DQ obligation over the year. CRA got rid of it when the DQ became completely simplified in 2010. Now, with these new changes, the 5% DQ, qualifying disbursements, it came back. The DQ tracking came back. So charity will need to report its DQ in its T3010. And with the new T3010 version 24 that was released for use by fiscal year end ending December 31, 2003, then there's another additional schedule that we need to complete. Next slide, please. First of all, there are 2 lines in the T3010 itself that a charity will need to complete before getting to the schedule. There's line 5900 and then there's line 5910. There's a lot of wording in it with examples. It's great bedtime reading. If your sleeping pill is not handy, just pull up my slide, read it. You will fall asleep in no time. So skip all the writing, go to the charts in the bottom of the slide that explains what those 2 lines means in the T3010. For example, if I'm looking at the DQ obligation for my fiscal 2024, again, I'm assuming December 31 as the year end. So I'm completing my 2024 T3010 fiscal. There's one line in the T3010, line 5900, that looks back to the previous 24 months before my current fiscal. So that would take us to look at the 24 months of 2022, 2023. So that's the 24-month period. That forms the asset base to calculate my DQ obligation for my current fiscal. So I went through that calculation early on in my presentation. So you calculate the average value of that 24-month period, collect the asset base, 8 period, 4 period, whatever, do the averaging, you come up with a number. You enter that number in line 5900. That's the number that will calculate the DQ obligation for my current fiscal year. And then there's another line, 5910. That requires the charity to look at another 24-month period, which is the current 24 months, the 2024, and the 1 year prior. So you calculate, you go through the similar calculation, averaging it, the 8 period, 4 period, you come up with a number. That number you enter into line 5910. That number is to help the charity to estimate what the DQ obligation is for its next fiscal 2025 for planning purposes. Next slide, please. Other than those two lines, the two calculations that the charity will need to do, there's a new question 17 in the new version 24 T3010, and then there's a new schedule 8 in the new version 24 schedule T3010. First of all, question 17, and that relates to line 5850. So it's the two is just one line in the T3010. That question is intended to weed out charities that owns investment asset below the 100,000 and the 24,000 threshold. So charitable organizations and foundation that have investment assets below that threshold, there's no DQ. They're going back to an earlier table that I have in my deck. So if the charity answer that as no, then okay, no DQ apply, all good, you don't need to worry about Schedule 8. However, if the charity answer yes, then you will need to complete Schedule 8. Schedule 8 is just a one-page thing. It is divided into top part and the bottom part, step 1, step 2. Step 1 is to calculate the DQ obligation for the current fiscal year that the charity is reporting, which is in my previous slide, the example of 2024. And there are also additional questions for the charity to answer in order to calculate whether the DQ obligation is met. So that's where the charity would enter how much is spent in the year on charitable activities or qualifying disbursements, which Terry we talked about. And then there's a step 2. Step 2 would calculate the estimated DQ obligation for the next fiscal. So step 2 relates to line 5910 that I just talked about. So step 1 is based on what we enter on line 5900 for the current fiscal. Step 2 relates to what the charity calculated in line 5910 for the next fiscal for planning purposes. Next slide, please. So I've talked about continuously not meeting the DQ obligation could be a problem. The charity could meet risk losing charitable status. So that's the mechanism in the Income Tax Act for charity to go to CRA to beg for mercy to reduce its DQ obligation. So there's a mechanism in the Income Tax Act to allow CRA to have a discretion to reduce a charity's DQ obligation. So that means the charity find it problem to meet its DQ, then they go to CRA for dispensation. The bottom two bullet is a little technical for techie tax people. There's a different mechanism on how that CRA reduction is done, so you can ignore it. But if you cannot sleep at night, again, that's great bedtime reading and good brain teaser. Next slide, please. The main thing to remember is, in order to go to CRA to ask for DQ reduction, because the charity find it impossible to meet this DQ, there's a policy that this sets out the policy in CRA's website. The reduction mechanism is only intended to help charity that has exhausted all avenue, and the DQ shortfall is caused by something out of the control by the charity, and the charity has exhausted everything possible. You went back 5 years, they tried to anticipate next year, and it doesn't think that it's possible to meet the shortfall the next year, then it can apply to CRA for reduction. It is discretionary. There's no guarantee that you will get it. And then the timing to go to CRA for that relief is the charity must have finished its fiscal, completed its T3010, found that there is a shortfall, and then looked around and have decided that the shortfall is created out of its control, is absolutely no way that they can meet the shortfall, then they can apply to CRA to see if they can get a DQ reduction. And also the Bill C-32 also included provisions in the Income Tax Act to allow CRA to release information to the public of any charity that has applied and received a DQ reduction. Next slide, please.
Theresa, just to mention, including questions, we have about 4 more minutes. So just to help you pace yourself.
Thank you. And then this is the form to use to apply. And if permission is granted, then you need to amend the T3010. Next slide, please. This slide, very quickly, this is a mechanism that was available before 2023. That allow a charity, if it wants to accumulate property, say for a building project, it doesn't want to include that money set aside to form the asset base for the DQ calculation, you can apply to CRA to exempt that asset base, but starting 2023, that is no longer permitted. Next slide, please. This slide talked about expenses spent on administration and management expenses. It is the Income Tax Act is now amended to expressly say administration and management expenses are deemed not to meet the DQ obligation. So what that means is still uncertain. CRA has not provided guidance on what that means. So that may create some uncertainty. Next slide, please. In the DQ, there's some rules about inter-charity gifts between non-arm's length charities, such as between a hospital and hospital foundation. If they're set up as non-arm's length, rules under the Income Tax Act, there are rules. So if there's a gift from a non-arm's length charity, then the recipient charity must spend the entire gift on activities, on qualifying disbursements in the current year or the next fiscal. Otherwise, there may be $110,000 penalty. Next slide, please. And the only exception is that the grantor charity can make it a designated gift under its own T3010. And the catch is, by doing it, yes, the recipient charity would have complete freedom on when to use the gift received by the grantor, non-arm's length charity, but the grantor, non-arm's length charity cannot use that inter-charity gift to meet its own DQ obligation. Next slide, please. Now, this slide explains how the grantor charity would report the designated gift in its own T3010. There are 3 steps. The little dashes are 3 steps. The T3010 is not clear. The instruction is not clear. The CRA guide is not clear. So if grantor charity was to make a designated gift, I would suggest that you look at this slide. You go to the T3010, the T20 T33 guide, and particularly click on the link that I inserted on my slide in order to see how to report that designated gift, because it's nowhere. It's not in the form. It's not in the guide. I think this is something that CRA should fix, either in the form or the guide. Next slide, please. There's another slide, please. Next slide. There's also another broader anti-avoidance rule that if a charity was to do something funny, enter into a transaction, any transaction that may reasonably be considered to avoid or unduly delay the expenditure, to avoid DQ, there may be another penalty as well. Next slide. This slide talk about there may be some challenges faced by charities because of increasing the DQ from 3.5 to 5%. What if it's endowment fund and there's no power for the charity to encroach? Do I need to get a court order? What if the investment asset does not generate 5% DQ? So there could be potential problems for charity in meeting its own DQ. Next slide, please. And if you take away the DQ is complicated, make sure that you track the DQ properly in the T3010, especially when the T3010 instruction is not clear on how to complete or fill out report designated gift. And my last slide includes some resources. Again, great bedtime reading material. If you cannot sleep at night, just put it up on the link and you will fall asleep in no time.
Well, thank you, Theresa. Who would have thought that disbursement quota could be that exciting? That is great. I think we should get a DQ sandwich from Dairy Queen for all people that have to go through the disbursement quota. We have just time for one question, Theresa, and it's this. We usually have our auditor complete our T3010s for us. With the new questions on tracking DQ in the T3010, what is the best practice on who is the best person to complete the T3010?
Wonderful. Excellent question. That happens to a lot of my clients. They kind of farm the T3010 outside to the auditor. Auditor do the financials, and then they complete the T3010, and then they just follow with CRA. The charity doesn't even look at it. That's not a good practice. So it is fine for the auditor to do a first draft. That is okay. But then the charity should review it, make sure that the questions are answered correctly. And the board should review it because there may be serious consequences for information that may not be correctly inputted into the T3010. And because many of the questions in the T3010 have legal implications, and many of the questions are designed by CRA with legal rules in the Income Tax Act behind. So it would be a good idea to seek a legal review, not to second guess the number crunching by the wonderful auditor or accountant, but at least to look at it on an overview basis, make sure that the questions are answered properly from a legal perspective.
Great. Thank you very much, Theresa. We're going to move on to our next topic. Joyce, we're going to pull up the slides for receding challenges for healthcare charities. Corina Weigl is going to present on it, and Corina is a partner and co-lead of Fasken's private client service group, focusing primarily in the estate and trust area, as well as in the charity and not-for-profit matters. And assisting her with the questions will be Emily Hubling, who is a partner with Fasken's and the Trust Wills Estates and Charity Group. Look forward to your comments, Corina. Over to you.
Good morning, everyone. I'd first like to thank my colleagues, Emily Hubling and Katerina Ignatova, for their assistance with today's presentation. But I'd also like to take the time to acknowledge the excellent materials that Terry, Theresa, and their colleagues produce and make available to all of us on their website, some of which have found their way into our presentation today. My topic has been entitled Gifting and Receding Issues. Next slide, please. What I hope to do in my 30 minutes is to spend a bit of time doing an overview of the rules related to gifting and receding. Then I'll spend some time looking at some unique scenarios that still cross our desks and may be relevant to all of you. And then lastly, I'll spend a few minutes dealing with what to do when you find yourself in the scenario when a gift goes bad and you may want to return a gift. Next slide, please. Turning first to what is a gift? At first instance, CRA adopts the traditional common law definition that a gift is a voluntary transfer of property by a donor to a qualified donee without consideration flowing back to the donor. For there to be a valid gift, you'll see that sort of 3 criteria plus a few other points layered on. First of all, it has to be a voluntary transfer of property to a charity. The donor has to intend to make the gift. The property transferred has to be property that is owned by the donor, and there can be no consideration flowing back to the donor, although the tax rules have provided an exception to that. The gift shouldn't be contrary to public policy, and I'll get to that. There has to be delivery of the property by the donor to the charity, and the charity actually has to accept delivery of the property for there to be a completed gift. From this definition, we can see that certain transactions won't qualify as a gift. Donations of services, donations of gift certificates, donations of the gift of the use of property. I want to donate the use of my cottage property, for example, to the Make-A-Wish Foundation. That's not receivable. Or promises to give or pledges. However, a number of years ago, the Income Tax Act, in recognition that donors may in fact receive some kind of benefits that are connected to their donation, introduced the split receipting rules, which is an override on the common law rule. The split receipting rules will allow a donation to be accepted by a charity, even if there is some benefits flowing back to the donor. The impact is, if there is an advantage that flows back to the donor, it will impact the quantum of the charitable receipt that the charity can issue. And I'll dive into this in a moment. Next slide, please. What's the relevance of the law related to gifts? Well, it comes down to the receipting rules that apply to charities that they have to follow. We all know that generally donors want to get the maximum amount of tax receipt they can get, but that's not always possible, particularly in the face of advantages that might be connected to a gift. So as a charity, you have to go through a process. You need to ensure that the donation is in fact a gift. That's an obvious statement, but it's not always clear. Did the donor have the requisite capacity? Are you concerned that they're not capable of making the gift? Is it voluntary, or was it being provided to you as a result of a court order or some kind of contractual obligation, so it's no longer voluntary? You can only issue a receipt to the person that actually made the gift. So if I make a donation to a charity, I can't ask you to issue a receipt in favor of my son. You wouldn't be entitled to issue him a receipt because I was the donor. What this also means is that you shouldn't be issuing receipts for anonymous donations. There is a way to accommodate an anonymous donor if there is a transaction done by way of an agent on behalf of a donor or in trust for somebody who wants to remain anonymous, but that obviously adds complexity. You want to make sure that the donor actually owns the property and that they can deliver good title to you. Once you're comfortable that there is a valid receipt, then you need to determine or a valid gift. Then you need to determine, well, what's the eligible amount of the receipt that you can issue to the donor? And in essence, that's a formula. It's based upon the fair market value of the gifted property, less the value of any advantages that are provided to the donor or persons non-arm's length to the donor. There are obviously 2 aspects that you as a charity need to trip through when dealing with that process. First, you've got to determine what's the fair market value of the gifted property. That's going to be easy when you're dealing with cash gifts, but for gifts in kind, the fair market value needs to be ascertainable, and the obligation is on you as the charity to actually determine the fair market value. There is this threshold of $1,000. If you as a charity expect the value to be less than $1,000, then you can engage in the valuation process or rely on somebody internal to do the valuation so long as it's reasonable to rely upon that. But if you expect the value to be greater than $1,000 for gifts in kind, then CRA strongly recommends that you engage a third-party appraiser to do the valuation. That's obviously going to add costs. So you always want to do a cost-benefit analysis. Are you spending too much to ultimately get the gifted property? It's also important to bear in mind the deemed fair market value rules. These were implemented a number of years ago to address abusive tax shelters that involved gifting arrangements. If the rules apply, then the value of the donation or the receipt is equal to the lesser of the value of the property donated or the cost base to the donor. The rules will apply if the property that is being donated was acquired by the donor as part of a gifting arrangement, a tax shelter arrangement, that's a complicated formula, or if the property was acquired less than 3 years prior to the gift, or less than 10 years prior to the gift, and it's reasonable to assume that the property was acquired by the donor with the intention of making the gift within that 10-year window. Once you've determined either the fair market value or the deemed fair market value of the gifted property, then you have to go through the process of ascertaining whether there has been any advantages provided to the donor or a person dealing at non-arm's length with the donor. The concept of advantage is exceptionally broad. It's any property, services, compensation, use, or other benefits that the donor could receive or a person's non-arm's length to the donor could receive that is somehow connected to the donation. And I'll come back to that point. It is exceptionally broad, but here the onus is on the donor to actually advise the charity if there are any potential advantages connected to the donation. If there is an advantage, then the charity can only issue a receipt if the value of the advantage can be ascertained and the value does not exceed 80% of the fair market value of the gift. And as I say, the concept of advantage is very broad. Go to the next slide, please. There is a de minimis rule, and the de minimis rule essentially says that where you have advantages where the combined fair market value is not more than the lesser of $75 or 10% of the fair market value of the gift, then you don't have to worry about calculating the value or reducing the charitable receipt. Next slide, please. Ultimately, that 80% rule is in effect, it leads to a presumption that if the value of the advantage exceeds 80%, then it's presumed that the donor didn't have the requisite intention to make the gift, which is why you can't issue a receipt in that context. However, as with most rules under the Act, there is an exception. There is still an avenue available for a donor to actually prove they intended to make a gift, even where the value of the advantage exceeds 80% of the value of the property. Next slide, please. Why is it important for a charity to have a good understanding of the receipting rules? And why is it prudent to get advice about donations that may be out of the ordinary? Well, it's because of the consequences that may be imposed on a charity for improper receipting. And there are 3 types of consequences a charity can face. First of all, a financial penalty, which is based upon a percentage of the eligible amount, potential suspension of tax receipting privileges, or God forbid, potential revocation of registered charity status. And the regime is based upon escalating consequences for repeated infractions. I'm not going to go over what the actual rules are, but this slide does go over the specific details about what the potential consequences are for improper receipting. Next slide, please. I want to shift gears now and focus on the second part of my presentation, which is addressing a few specific scenarios that might cross your desk. The first one I want to focus on is the situation of donations being received by a charity that are intended to be used to provide benefits for employees. It's not uncommon for employers, certainly in the for-profit world, to want to establish programs that are intended to reward employees for a job well done, example, give them gift cards, provide programs intended to result in skills development of their employees, for example, team building events, or even go so far as to provide funding for employees to pursue educational programs that are anticipated to result in benefits back to the employer, certificate programs, subsidizing degree programs, things like that. For most employers, there will be no questions asked about engaging in these types of expenditures. For employees who receive such benefits, there should be no surprise that most benefits would be taxable to them. The question I want to address today is, does the charitable context change the answer? Can a charity provide these types of benefits to employees that would not be uncommon in the for-profit world? The short answer is yes. Well, how do we get to that short answer? What's the concern here? The concern is the view that CRA holds that charities have to operate to provide public benefits only and shouldn't be carrying out their activities to provide any private benefits, which of course employee benefits would be of a private nature. Notwithstanding that general principle, CRA's position is that it is inevitable and permissible for some benefits to occur when a charity pursues its charitable activities. It's always a question of degree. In the context of employee benefits, they are generally considered acceptable if 4 criteria are met. First of all, they have to arise directly through the pursuit of the charity's purposes, but they have to remain incidental to the charity achieving its charitable purposes. They have to be reasonable. They have to be necessary for the charity to be able to further its charitable purposes. So if it's common business practice for employers to provide benefits of the nature the charity is thinking about, then I would view that as being necessary for the charity to be able to continue to retain good employees. Lastly, the benefits cannot amount to a non-charitable collateral purpose for some other entity. For example, the promotion of a business, where a business might want to make a donation to a charity that then gets used to provide benefits, and that business then goes off and promotes the fact that that's what it's done. If that's the situation you find yourself in, it is possible to issue receipts for donations that are earmarked for employee benefits, but in the context of a business donation who wants to then promote it, you're right into the advantage rules because the business will be obtaining an advantage. And then the difficulty will be, can you actually quantify the advantage that the business has received through that promotion activity it's engaged in? The likelihood is they won't be able to value it, or you won't be able to value it. And if you can't value an advantage, you can't issue a charitable receipt. This doesn't necessarily leave a business without any avenues. They could go off to get legal advice about whether that type of a contribution to a charity could be treated as a legitimate business expense and otherwise deducted from the business's income. Next slide, please. The next scenario that I want to address is whether a charity can issue a charitable receipt either to an individual, let's say me as a donor, or to a corporation that the individual controls, I'll call it my donor corporation, for a gift that either I make or my corporation makes to a charity, where the charity is then either going to engage in research, and that research is going to benefit a separate corporation that I'm either a shareholder of or my corporation is a shareholder of. And the question is, does this raise any red flags? And it should. It should raise the flag of the split receipting rules. Where a donor or a person non-arm's length to a donor, as I said before, is going to potentially receive an advantage, then it's going to impact either whether you can issue a receipt or at all, or what the quantum of the receipt here is. The question is there an advantage in the context I just proposed? And the answer, if it's not obvious, is yes. I will have the potential, because the charity is engaging in research, and that research is going to benefit a separate corporation that I'm a shareholder of, or my corporation is a shareholder of. There's a potential for my share value to increase, or for me to receive dividends from that incubator corp or that research corporation in the future. So that is an advantage. And the point is that the advantage does not need to exist at the time the gift is made. It can arise at some point in the future. And it need not actually come directly from the charity. It can arise as a result of, in this fact, the fact that I'm an owner of a corporation that's going to benefit from the charitable research. In this context, it's going to be very difficult to value the quantum of the advantage. And so it's highly unlikely that the charity could issue me a receipt for the donation that either I made or my corporation made. Next slide, please. Another scenario we are still seeing some charities asking about is donations of cryptocurrency. Now, I must confess, don't ask me anything technical about cryptocurrencies, because I don't still profess to understand all of the underlying details about these quote unquote assets. I'm still trying to get my head around the transaction back in 2022 where the artist Beeple sold an NFT token for $69.3 million that was ostensibly art, but it wasn't something you could put on your wall or put on your counter. So I don't profess to have all the technical details. But some things to bear in mind here are cryptocurrencies are not considered legal tender, so they're not cash. They're considered commodities for tax purposes. The implication of this is that it triggers the rules related to donations of gifts in kind that I spoke about a few minutes ago. The challenge that then arises for a charity is the valuation process and whether the deemed fair market value rules apply, because cryptocurrencies are relatively new, and a donor may not have owned the cryptocurrencies for longer than the 3-year window or the 10-year window if, in fact, they acquired the cryptocurrencies for the purposes of making a donation. Next slide, please. The bottom line with cryptocurrencies is you're going to have to go through the valuation process. And unless you've got requisite expertise internally and you expect the value to be less than $1,000, you're going to have to engage a third-party valuer to come up with what the value of the cryptocurrency is, which is likely going to add extra costs for you. Next slide, please. And you can actually go to the next slide. Some of the other challenges that arise with cryptocurrencies is there are different types of crypto products that are out on the market. You need to give some thought to which of the various options that are available you're actually open to accepting. You want to make sure that the donor actually has good title and custody of the cryptocurrencies that they're proposing to donate to you. You want to understand whether the cryptocurrencies are located in a digital wallet, and where is the key for that wallet? Is it in the control of a third party, a custodian? And is that custodian reputable? In essence, how are you actually going to make sure you can get access to the cryptocurrency that's being proposed as a donation? More importantly, can you actually hold on to the cryptocurrency? Is it a prudent investment? Is it going to fit within your current investment policy statement, or do you need to go through the process of reviewing that and potentially revising it? What if your plan is to sell the cryptocurrency? Is it something that can be monetized relatively quickly? What's the time horizon? Does that fit with your liquidity plan as part of your investment policy statement? And then obviously you need to think about the potential implications of money laundering and the rules related to terrorist financing, which have made these types of donations even more complicated. Next slide, please. Another thing that we continue to get questions about is crowdfunding. Crowdfunding essentially involves donation-based fundraising by appealing to a crowd, so a broad group or network of smaller donors over a period of time that's limited, typically 30 days or 50 days. And it would typically involve a service fee being charged by the crowdfunding platform, and there are a number of platforms that exist on the market. Those platforms will have their own terms of service for using the platform, and those terms will govern the use of the platform, how they store the private information of the donors, the intellectual property underpinning the platform, liability for any representations that are made about the funding arrangement, the charity, the purposes of the funding arrangement. You as a charity are going to want to carefully review all of the elements that are being disclosed as part of the crowdfunding exercise to make sure it's consistent with your charitable purposes. Though the terms of service will address the governing law, which may not be Ontario or your local law, it'll deal with how you can actually access the funds. And then obviously it will deal with whether there are fees being charged by the platform, typically of a percentage nature that is taken off of the top of each donation or otherwise a flat fee. There are two types of crowdfunding platforms that we've seen. There are those that are sort of supporter generated and those that are designed at the organization level, at the charity level, which is going to be better from a charity's perspective. Next slide, please. Some of the other issues that crowdfunding raises, first of all, can you issue donation receipts for donations that are made through a crowdfunding platform? The answer is yes, but you got to go through all the same analysis you would go through with any donation, including whether there's been any kind of advantages. You need to think about whether you have control over the messaging that the platform is being sort of conveying out to the market and make sure it's consistent with your charitable purpose and your vision and mission. You're going to want to understand whether there are any restrictions being imposed by any of the particular donors or overall vis-a-vis all of the funding that is obtained through the crowdfunding platform and whether you can actually meet those restrictions. Most importantly, you're going to want to make sure that the funds are being raised for a charitable purpose. The easiest example that's problematic is it's not unusual for crowdfunding to be designed to provide benefits to a particular individual or a particular family. That is not charity. That's considered philanthropy, and it's not something that's receivable. There are also models that engage cryptocurrencies, which are problematic. And then obviously crowdfunding has the potential to involve foreign donors, which raises its own issues. Next slide, please. The last topic I want to address before spending just a few minutes on gifts going bad is gifts that might be contrary to public policy. If you have a scenario where you're concerned about whether the gifted property has been the result of illegal activity, you've obviously got to step aside because it's not a valid gift. If there are conditions attached to a donation that are discriminatory in nature, that's problematic. And if you're being asked to accept a gift that might require you to act in a manner that's inconsistent with municipal laws, provincial, federal, any laws, obviously that's problematic as well. The most common types of problematic conditions that end up going to court surround or apply to scholarships, and typically conditions that are viewed to be racist or fostering religious superiority, things of that nature. There are the easy types of conditions that we can all agree off the top are problematic from a public policy perspective. The challenge is that public policy changes over time as societal views change over time. Sometimes it's really easy to identify things that are problematic. Sometimes it's not. When in doubt, when you feel uncomfortable with what a donor is proposing, get some advice, because you don't want to find yourself in a scenario where you might have accepted a gift that's problematic for you later on, and you've got to think about returning a gift. Which brings me to the last topic. What to do when you've received a gift, you're worried that it might be, next slide, please. The gift, you might not like the terms anymore. It might be problematic. The easiest example of this that I know of is a donor has made a donation to a hospital, let's say. There have been naming rights attached to it. And then either the donor has been convicted of some kind of bad behavior, criminal activity, for example, fraud, or even think about the Sackler family, Purdue Pharma, where public opinion has changed significantly and materially against the Sackler family in the face of the OxyContin crisis, where at least 20 worldwide institutions have gone through the exercise of removing their name from a building, an art gallery, an educational institution, simply because they wanted to disassociate themselves from the Sackler family and the means by which they actually accumulated their wealth. It's important to remember that you're not obligated to accept a gift. In order for a gift to be completed, you have to have accepted it. So the easiest way to avoid a scenario where you might find yourself having accepted something that becomes problematic later is to do your due diligence up front. And Sophie is going to speak and go into greater detail about gift acceptance policies. And we would highly encourage you to go through that, because if you have a good policy, you can avoid potential issues later. But some of the things you want to potentially address there is, does the gift include restrictions that you can't meet? Is it going to be too difficult to administer? Are you being asked to act too quickly to accept the gift so you can't do your due diligence? Is it going to fit with your investment policy statement? Are there conditions that you simply can't meet at the end of the day such that you shouldn't be accepting the gift? Next slide, please. The other side of the coin that I call the gift, when gifts go bad, obviously the first side of the coin is have a process in place to make sure you're not in a situation where you find yourselves thinking about having to potentially give back a gift. But what happens if you actually do find yourself in that situation? You don't want to keep the gift, or you want to change the terms. What can you do? One of the easiest, some of the points that you need to bear in mind is, first of all, if there has been a valid gift, you cannot simply return it unless you find yourself in a scenario where the gift had conditions and those conditions can't be met. The law related to conditions is exceptionally complex because there are two types of conditions precedent and conditions subsequent. And depending upon the nature of the condition, it will impact whether you actually can give a charitable gift back. Secondly, thinking about returning a gift to a donor could actually be considered to be a breach of trust by the charity and could expose the board to charitable complaints. There's been a recent situation involving a donation to a university by the Neville family. And the donation was made, and it turned out that it was for scholarships that could potentially benefit members of the Neville family. That obviously was an advantage. And the charity was in a situation where they couldn't quantify the advantage, so they couldn't issue a receipt. The donor basically asked for the donation back. The charity refused to give the donation back because the gift had been completed. The case went to court. The donor actually sued the charity to get the gift back, and the donor lost. And the donor lost because there was a valid charitable gift completed. The fact that they couldn't get a receipt for the gift was irrelevant to the fact that the gift had been completed. The point here is this obviously had reputational implications to the charity, which we never want to find you in. So if there is a potential scenario where you might be thinking about the risk of having to give a donation back, or a donor is asking for funds back, you want to get advice. That advice should think about the communications you want to engage in with the donor, but also communications you want to engage in with the public at large, because of the reputational risks that come with charities potentially giving donations back. If you find yourself in the scenario of thinking about giving a donation back, there are obviously the tax sides to this. Next slide, please. Why do we worry about the tax side? And you can go to the next slide as well. It's because charities can't simply disperse funds to non-qualified donees outside of that defined term Theresa referred to about qualifying disbursements. So in the context of potentially giving funds back to a donor, they're obviously a non-qualified donee. So that becomes problematic for the charity, and they run the risk of getting their registration revoked. But if the decision is to ultimately return a donation, there is a statutory process for the charity to follow, and that process will involve filing an information return. And that information return will have implications to the donor's tax situation as well, which is why communicating with the donor is critical to this process. The last point I want to make is, if you find yourself in a scenario where you have issued a receipt and you shouldn't have, or the value was too high, you want to get advice about what to do because of the consequences for improper receipting that I spoke about a moment ago. And likely that advice should be considering whether you want to make a voluntary disclosure to the CRA, because it's always better to get ahead of any potential tax issues with CRA than let them find those tax issues and come after you after the fact. Those are my comments.
Well, thank you very much, Corina. You covered a lot of territory, and really it was very helpful with the resources. Emily, we're going to have two questions, but just two brief ones. There's a question from the audience that says, and this deals with the deemed fair market value rules. Do we need to be asking if donors have owned share securities for more than 3 years? So is there an exception to the deemed fair market value rules? Anyway.
Do we need to be asking if they've owned it for 3 years? I'm actually, Corina, can you jump in on this one?
Yes, it's prudent for.
I was going to say, like, from a due diligence perspective, you want to be gathering as much information as you can.
Right, and that's good. But the deemed fair market value rules does have an exception for publicly traded shares. So that just helps to clarify that. Then the other question is, are there any types of gifts to which the de minimis rule for split receipting does not apply?
There are. So the first is cash or near cash equivalents. So if the object received back is like a redeemable gift certificate, for example, that is not subject to the de minimis rules. And anything that is the object of a fundraising event. So if you have a meal at a fundraising dinner, if there's a golf event and there's green fees, cart rental, a meal there, that is not subject to the de minimis rule. The full fair market value of that needs to be deducted when calculating the value of the gift.
Emily, just one more. Registered charity works for a for-profit partner to promote sale of the for-profit partner's items or services on the basis that part of the revenues will go to the registered charity. For-profit partner may ask for a charitable receipt. Is that appropriate?
So this is a bit complicated. It goes to the question of whether or not this is a charitable receipt or whether it's actually properly a business expense that can be deducted. The tricky thing is you need to figure out what the advantage is there. So if a business is doing this work and they're getting back a promotional benefit for doing it, you need to figure out what the value of that promotional benefit is. If it's more than 80% of the amount gifted to charity, then there's no intention to make a gift, as Corina covered in her presentation, and there can't be a receipt issued. If that's the case, there may still be an opportunity to deduct the amount as a business expense, sort of advertising promotions. But if it's less than 80%, then yes, it can still be properly receipted. You need to figure out what the value of that advantage is, which is obviously potentially tricky when you're dealing with something like promotional value. Like how do you quantify that? What is that? So it is challenging, and it may be something that's worth seeking advice, but it is technically possible to get a receipt in that circumstance.
Well, great. Thank you very much, Emily, for that. And we're now going to take a break. We're going to stay on time. So it's a 5-minute break instead of a 10-minute break. During the time, the 5 minutes, we'll have information about how to sign up for the newsletters. Come on back at 10:25. And we'll start again, and Lynne will be the moderator at that time. So see you back in 6 minutes. Thanks.
Hello, everyone. Welcome back from our little break. You're back in time to hear from Terry Carter, who's going to speak to you about the new qualifying disbursement regime. You've heard about qualifying disbursements from a couple of our speakers so far. And Terry, we're going to turn it over to you to tell us a bit more about that.
Well, that's great, Lynne. Thank you. And I thought there's a lot of material that we're putting out today for you folks in the audience, and we need to lighten things up a little bit. So even though Lynne told me I couldn't tell any dad jokes, I'm going to tell some dad jokes because we need a break. So it's Valentine's tomorrow. So here you go. Some dad jokes. When should you ask someone out on a coffee date? When you like them a latte. Okay. What did the couple say after they were struck by Cupid's arrow? Ouch. And then my last one, I'll keep one to the end. What did the chefs give to his wife on Valentine's Day? A hug and a quiche. Okay, next slide, please. This is a tough topic. I sympathize with folks who run charities and trying to keep up with all the rules. So this is a qualifying disbursement regime we're going to be talking about. And if you want more details, down at the bottom, there's going to be a link in the PowerPoints that we sent out to you to a bulletin that we put together that hopefully provides some explanation. Next slide. So what's the context? Why is this a topic that you need to be concerned about as a healthcare charity? Well, you need to understand as you're raising monies, what are you going to do with the monies as they go out the door? And sometimes you need to work with organizations that are not registered charities, or more technically referred to as non-qualified donees. Qualified donees under the Income Tax Act includes municipalities and governments and registered charities. So if you're having to work with a party that's not a registered charity, it does add some complexities to it. And in the healthcare area, this could come up as an example down at the bottom of the slide. A healthcare charity that was wanting to fund a community health initiative run by a community organization that's not a registered charity, it's a non-QD, or a hospital foundation that might have broad community purposes, broader than just the local hospital, and wanting to make a grant to a local Indigenous healthcare charity that is not a qualified donee. So those are the contexts we're going to talk about. Next slide, please. In understanding the development of the qualifying disbursement regime, we go back to June of 2022, new legislation came into place that permits qualifying disbursements, which I'll explain in a minute. Canada Revenue Agency came out with a guidance at the end of November of 22, and there was lots of feedback from the sector. And then CRA came out with what they refer to as their final guidance on, quote, registered charities making grants to non-qualified donees. And that's how they describe what the guidance deals with, is grants to non-qualified donees. So that's the terminology that they refer to, and that's what we're going to be talking about today over the next 30 minutes. Next slide. So if you're kind of wanting to understand, get your head around the new disbursement, qualifying disbursement regime, what you need to understand is what was in place before June of 22. And that was shown in this, it's shown in this slide here, that charities could only do two things. You could either cut a check and give a gift over to a qualified donee, like another registered charity, or you could conduct your own activities through your programs and your employees and volunteers. Or if you wanted to work with a third party, then you'd have to get involved in complicated arrangements with the intermediaries through direction and control under the control of the charity as an extension of the charity for its own activities. And lawyers did a lot of work in putting together agreements that could achieve that result. Next slide. So then we come to June of 22. I put this section from the Act up, not to bore you or to frighten you, but rather at the end of the day, you will want to go back and look at the legislation, because this is the parameters by which you have to work if you're going to be involved in qualifying disbursements. You'll see at the top, it refers to either a gift or, quote, otherwise making resources available. And you can then make it either to a qualified donee, which is basically what we had before registered charities, or you can do it to a grantee organization. And they give a definition for grantee organization that it's a person, it's a club, it's a society, association that is not a qualified donee. So basically, it's not a registered charity. So you can do that if you're furthering the charitable purpose of your charity, and you're ensuring that that gift, that qualifying disbursement is going to be used for charitable purposes of your charity. And then there's sufficient documentation to, in essence, prove that that's the case, that the purpose and the application is following through. So that is it in a nutshell. That's qualifying disbursements. Next slide, please. So now we have two different regimes. Canada Revenue Agency did a helpful chart, which I copied over here. On the left-hand side is the old regime of activities, own activities, which you do through either staff or volunteers, or the new regime of making qualifying disbursements, and that involves gifts over to qualified donees or grants to non-qualified donees, referred to as grantee organizations. Next slide. All right. So the final guidance that came out, I'm not going to spend a lot of time on it. If you haven't read the final guidance, you need to. And you need to read it a number of times. To be fair to CRA, they've worked hard to try to make it readable. So it's an improvement over the draft guidance. But even at that, it is not intuitive. It is not easy. So you must read it through. Don't just leave it to your legal counsel. You need to read it through yourself. What's helpful, CRA says that the guidance is not law. Oh, great. And that's good. And they also say they're going to take a reasonable and flexible and proportionate approach, which is good. But at the end of the day, whatever is in the guidance, the final guidance, it will become de facto law simply because there's nothing else to explain to charities how they're supposed to operate. So it's not law, but it is kind of de facto law. Next slide, please. I'm going to go through these fairly quickly and just highlighting some of these sections out of the guidance. This section here, the explanation is the CRA has, setting out the provisions of the Income Tax Act and their interpretation and approach. And it's very good, very helpful. I commend them for putting that together. And they indicate that they want to adopt a reasonable and flexible and proportionate approach to granting. Next slide. Then they have a section that talks about how you can operate, either going back and forth between the own activities or the qualifying disbursement regime. You got to make sure you have to properly document it. And then they get into the heart of the guidance, which is the due diligence review. And I set out some of the definitions from it because it's a bit circular. The due diligence are the steps you need to do in order to comply with the Income Tax Act, and you do it through accountability tools. And then accountability tools are the due diligence measures you need to meet accountability requirements, and then accountability requirements are the requirements in the ITA. So it's all kind of circular. But bottom line, CRA takes the position that you need to follow due diligence steps. Next slide, please. The due diligence steps are set out in the guidance. First thing you do is you've got to make sure that whatever you're going to do through your grant, qualifying disbursement to an NQD, it achieves the purpose of the charity. So check your purposes and make sure that you're complying with them. It isn't any charitable purpose, it's the charitable purpose of your charity. So if you haven't looked back at your articles of incorporation, or letters patent, if you're of an older variety, you need to do so to find out what you have the charitable purposes to do. Next, they indicate that you're to assess the risk level for a particular grant, and they break it down into low, medium, and high risk. And they indicate it's not an exhaustive list. And if circumstances change, then you need to reevaluate the risks. So there's a pretty significant focus on the matrix that they provide. Next slide, please. And then you're to determine whether or not the particular circumstances that you have in wanting to make a grant are going to be properly addressed through the accountability tools that they talk about in the guidance. And they refer to accountability tools, including an assessment and review of the recipient, the grantee, description of the grant activity, written agreement, reporting plan, transfer schedule, separately reported track funds. So it's a whole analysis that you have to do. And that's based upon a determination of whether you're low, medium, or high risk. And up at the top of the slide, it talks about the different factors that the guidance takes into account to help you. It's a bit exhausting, frankly, but still the tools are there. Next slide, please. And after you've done that assessment and looking at the accountability tools that are available to you, then you apply the accountability tools, you work with the recipient grantee on a collaborative basis, and hopefully you move forward with your grant. Remember, a grant is it's a gift of money or property, or otherwise making resources available, which I'll talk about in a minute. And then after you've done that and you've moved forward with your grant, presumably because you have board approval for it, then you got to document it. And you need to document it in detail because you have an obligation under the Income Tax Act that you must be able to provide CRA with records to prove that you're compliant with all aspects of the Income Tax Act for charities, and that there's no basis that CRA would have to revoke you. So it's an onerous obligation that you need to have. And your books and records need to allow them, CRA and an audit, to show you've met the accountability requirements. you've got appropriate supporting documentation, and the recipient, the grantee, will continue to use it. If you don't, CRA reminds you that you could be subject to an audit and you could be subject to compliance measures, nasty things that can happen, and penalties and even revocation. So you need to take it seriously. Next slide, please. And then they have the last portion of their guidance talks about special topics. It explains some of the changes in the Income Tax Act, and I've listed some of them here for you. We'll talk about directed gifts in a bit more detail, reporting the grants, which we'll talk about. But it does have a helpful section dealing with the grant of real property or money to buy real property, particularly if you're a healthcare charity working in a developing area. You may not be able to own property in that particular country. So this is a very helpful explanation of how you can have a third party receive a gift of either the land or building or money to buy land and buildings in a developing area. So this is a definite improvement over what's available for the own activity regime. And then there's a reminder about anti-terrorism considerations. Not a great idea to be funding terrorists either directly or indirectly, so they give you some helpful tips in that regard. Next slide, please. All right, so let's talk about some of the issues that you need to think through. You're a healthcare charity, and you've heard about the qualifying disbursement, and you're thinking, you know what? I think it's time that we make a grant. We're not really fond of working with intermediaries in more of a sort of a hierarchical approach, sort of a colonial mentality. We actually want to bless the recipient with a gift so that the recipient, the grantee, can use it for their programs. Great. What are the things you need to think through? Well, first of all, I just want to point out that the guidance talks about terminology that's not in the Income Tax Act. There is no reference in the new provisions in the Income Tax Act about the word grant. It does talk about grantee organizations, that's for sure. But grant is a term that CRA uses. Same thing about grant making. Go back to the Income Tax Act, check to see what it talks about, because qualifying disbursements there are clearly defined as being either a gift or otherwise making resources available over to either qualified donees or grantee organizations. Why is that relevant? Because at the end of the day, if you have to explain things on an audit and you happen to get into court, it's what's contained within the legislation, which is the prevailing authority as opposed to the guidance. What CRA does do in the final guidance explains that they're using the word grant for a particular purpose. It's not necessarily the same term that's used within the sector. So that's helpful for them to acknowledge it, because we use the word grants for government grants and a number of different applications. Here, the word grant is limited to what's being dealt with under the guidance and under the Income Tax Act, even though it's not part of the Income Tax Act. Next slide, please. And next, you need to take a look at your charitable purposes. And if you are a foundation that has a single purpose of cutting checks over to QDs, over other registered charities, you will not be able to make a qualifying disbursement. Why? Because you do not have a common law charitable purpose of relieving poverty or healthcare or whatever. And CRA makes it quite clear that if a foundation wants to do qualifying disbursements, it will need to review its purposes and basically amend its purposes to allow for a charitable purpose, common law purpose, to be in place. So that's something that will impact community foundations and may impact some healthcare foundations as well. You don't have to, but if you want to do qualifying disbursements, making gifts over to non-QDs, that's what you'll need to do. Next slide. Another thing we point out that you need to be aware of is that the guidance adds a lot of additional provisions which are not contained within the Income Tax Act. Given a reference in the top left corner, risk, which used to be referred to 62 times in the previous guidance, but it's now down to 31 times. It's still a huge focus that they have. And we've done studies compared to other jurisdictions. It's very similar to the US Treasury Risk Matrix and the Financial Action Task Force in trying to track down terrorists. It just doesn't seem to be appropriate that there has to be such a high degree of risk in being, particularly for domestic purposes, but there it is. And the risk talks about it's going to be risky if you're going to do a grant above $50,000 or outside of Canada, but doesn't really explain why $50,000. It becomes a, quote, high risk. And again, the reference to due diligence is throughout the document, but there's no reference in the Income Tax Act. Next slide. And reference to accountability, it's mentioned 66 times, not in the Income Tax Act. It's similar to the US concept of expenditure responsibility, which is not fun. It seems to be imported into Canada. And those requirements are very similar to requirements that were in the early version of Bill C-19. The sector got rid of it, required finance to get rid of it, but we've kind of got indirectly some of those requirements back in place. So the whole qualifying disbursement regime, frankly, is more onerous than we've had under the direction, control, and own activity regime. Next slide. And a couple examples of that, dealing with pool grants where you're able to, again, pool a particular grant together with other non-QDs is complicated. And the guidance warns charities about it, that it's complicated. So I'm not sure whether it's any more practical to do pool grants than it was before. Charitable goods, where you want to do, for instance, a grant of medical supplies, it should be easier. It's not. It will require documentation in place. And frankly, compared to charitable goods under the own activities regime, it seems to be more complicated as well. Next slide, please. The reference to otherwise making resources available, it really isn't explained in the guidance. It could either be a gift, what we refer to as resources, by the way. Resources is whatever a charity needs to use in order to achieve its charitable purposes. So it could be property, could be staff, it could be space, could be volunteers. All of that is sort of within the definition of resources if you go to the fundraising guidance that CRA has put out. Well, what does it mean, otherwise making resources available? Is it gifting non-monetary resources, or is it, quote, making available non-monetary resources? And I think it's the latter between the two. But that gets into issues of trying to track your disbursement quota, because on the new T3010, when you're dealing with qualifying disbursements, you have to distinguish between those items which are monetary and non-monetary, and then you have to be able to indicate the value of the monetary resources. Next slide. That leads into the issue about some qualifying disbursements do not meet the disbursement quota that Theresa talked about. And the guidance doesn't really explain this. And this is important because if you're concerned about how you're able to meet your disbursement quota, gifts over to qualified donees or non-qualified donees, that will count towards meeting your DQ. But making resources available will not. So that means you're making space available, staff, volunteers between a charity and a foundation or other types of healthcare charities. It will not count towards meeting your disbursement quota. So that's an important consideration to keep in mind as you're planning how you're going to track this. Next slide, please. Then there's a provision dealing with directed gifts. I'm going to spend a lot of time. Actually, I'll spend a few minutes because it's important. Basically, the Income Tax Act was amended to say that a charity can lose its charitable status if it's accepting a gift, quote, the granting of which was expressly or implicitly conditional on the charity making a gift to an non-QD. What CRA says in the guidance is if you make it clear that the charity's in control and that there will be no return of the gift, then you're going to be okay. You're not going to be caught by the directed gift provision. Next slide. I would just point out that the wording that's in the Income Tax Act talks about a conditional gift. And a conditional gift, a common law, means there's a right of reversion. And they give an example of an express conditional gift, which includes a right of reversion. That's great. But then they give, as an example of an implicit conditional gift, where a charity has in its name the name of a non-QD, and somehow that is problematic, even though there's no right of reversion. So I think that there are some problems associated with it. We set that out more in our guidance, in our bulletin I mentioned at the beginning. And so they do make a reference that you won't have a problem with the directed gift provisions, though, if you do a gift under the own activities regime under direction and control. So it's going to be a little bit of an interesting seesaw which way you should go. Next slide, please. Reporting qualifying disbursements, kind of running out of time, so I won't spend too much time on this, but the T3010 has become a lot more complicated. You have an obligation for every grant that you do, you have to give the name of it, the purpose of it, and the total amount. And that's now set out in the revised T3010-24 that came out. It was also reflected in a form being a T1441 that came out in May of last year. Next slide, please. And when you get a chance to go through it, a lot of reporting is going to be required, right? So if you want to do grants, before you do it, take a look at the T3010 and see what you're going to have to provide before deciding to go ahead with it. And we have a guidance we put out with some comments concerning the new T3010-24. Next slide, please. So the last thing that I wanted to cover is kind of the proverbial question. Okay, Terry, there's two regimes, but which one do I go with? So what I did is I sort of did a bit of a comparison chart between the two regimes to kind of help me, frankly. And if you look at the horizontal lines, you'll see number one, on activities focused on the directing mind of the charity. Qualifying disbursement is more about supporting the recipient organization. Number two, on activities, more hierarchical. Qualifying disbursements, more collaborative. Number three, on activities, you can't do a gift, but you got two different numbers there. Number three should be over here. It's either gifted or otherwise made available. Number four, the regulatory due diligence is direction and control, but for qualifying disbursements, it's dealing with the risk matrix. Next slide, please. And then some other comparisons. Number five, you need to have an agreement that reflects direction and control for own activities and qualifying disbursements. You need an agreement if you're doing grants above $5,000. Number six, from a liability standpoint, you're probably better off with the qualifying disbursement regime because it's a gift. Number seven, own activities will go towards meeting your DQ, qualifying disbursements. Not everything will go towards meeting your disbursement quota. Number eight, It's a bit easier to buy real estate with the qualifying disbursement regime. Number 9, I'm not an HST lawyer, but there are some considerations that you do need to take into account. Talk to your HST counsel. There are differences between it. If you make a gift, a qualifying disbursement in Canada, it will not attract HST, according to folks I've talked to. And then finally, the onerous requirements of the T3010 own activities is less onerous than the qualifying disbursement. Next slide. So what are the takeaways? Okay, it's qualifying disbursement. It's an important new option. It's good, better than not, but it's complex. You need to do your homework to figure it out, particularly on the due diligence requirements. And third, you should be working with your legal counsel and your accounting professionals to help you go through the process. And then finally, stay up to date. There likely will be some further changes coming out, possibly in the T3010 maybe, or even on the guidance itself. So that's a walkthrough of the wild world of qualifying disbursements. And I think the only thing that really matters is that I have enough time to tell one more dad joke. Here we go. Do skunks celebrate Valentine's Day? Sure, they're very sentimental. Lynne,
I want you to know that in the green room here, Terry, we were laughing at your dad jokes. Not sure about the audience as a whole, but we were.
thank you very much. Thank you. Okay.
Terry, you did have one question which has already been answered, and since we're now short of time for you, I think we'll go straight to Sophie.
Please do.
So now, everyone, I'd like to introduce my fantastic associate, Sophie MacRae, who is going to speak to us about gift acceptance policies. And a lot of what has been said earlier today about due diligence and things that you need to put in place so that you're not having to return gifts later will be covered by Sophie in this talk. So over to you, Sophie.
Thanks, Lynne, and thanks, Terry. And I agree that I think this topic ties together some of what's already been presented on today well, because a lot of the topics that were discussed today can be addressed not to the full extent in your gift acceptance policies, unless you want it to be a textbook, but can be overviewed in that policy. Joyce, can you go to the next slide, please? So for my presentation today, I'm going to provide an overview of topics that are often addressed in gift acceptance policies or that charities might want to consider addressing in their gift acceptance policies, and also discuss how those policies are used. And then I'll also go a bit into considerations with respect to accepting certain types of gifts, and some of those have already been touched on in some of the prior presentations. And like Corina, I would also like to acknowledge that Carter's has great resources on these topics available on their website. So I thank them for being thought leaders on these topics and encourage everyone to go check those out. Can you go to the next slide, Joyce, please? So why should a charity have a gift acceptance policy? Having a gift acceptance policy will support the charity's compliance with laws. The CRA has specific policies on a lot of different types of gifts. So depending on how specific your policy gets, you'll want to review those and incorporate or possibly link them or refer to them, reference them in your policy. And reviewing your policy regularly will also support your compliance with those laws and any new guidance that CRA releases. Beyond just the Income Tax Act and CRA guidance, there are other laws that might be relevant to healthcare charities. For example, it would be very problematic if any gift were to be accepted in a manner that would be perceived to provide a preference in accessing insured, medical services, for example. So having a policy will support your ability to comply with the law and also show the steps that you're taking to do so. Having a policy also supports compliance with the charity's purposes, mission, vision, and values. So I'll discuss later in this presentation why those are an important reference point when considering accepting different gifts. And so there might be specific examples that you're able to identify where you wouldn't accept gifts of a certain nature because you've identified that those aren't aligned with, the purposes of your charity or your vision and values. But this is also sort of a more general guiding point, a test to keep in mind if some unusual or potentially problematic gift or donor relationship comes across your desk. A policy can also manage staff and donor expectations, so it creates transparency and consistency for decisions regarding gifts. It will assist your staff in flagging issues that might warrant a higher threshold of approval, or might, suggest that it might be appropriate in that case to seek further advice, including from external advisors, for example. And as mentioned, your policy might address specific examples of gifts that you've determined are acceptable or unacceptable based on the experience of the charity, although it won't be possible to contemplate every scenario. So it should provide as well some general guiding principles that can be applied by staff, officers, and directors of the charity. And then ultimately, as Corina had mentioned, the purpose is sort of to strike a balance between the benefits of a gift against the costs of receiving it. So it'll allow you to consider where the risks or, the administrative expense of receiving a gift might outweigh the benefit in that case. Joyce, can you go to the next slide, please? So this slide just sets out some considerations you might want to take into account when drafting your gift acceptance policy. And I'll say that there's no, one size fits all or standard template, and found a few examples that are of varying different lengths. One consideration you might want to take into account is whether you'll have one policy addressing, all these topics, for example. So the list I've put on the slide includes accepting gifts, declining gifts, due diligence that you might conduct, your approach or requirements for donor recognition. So that would include naming rights, for example, determining fair value of gifts, and also receipting. And so you may, have one policy, or you may have different policies. For example, a receipting policy or a policy on due diligence. And part of what may contribute to those considerations are whether any of these policies will be external facing or shared with potential donors or put on the charity's website. And as I had mentioned, it won't be possible for your policy to cover all scenarios, but if you find yourself in a position where you've gotten questions in the past about a particular kind of gift, or you find that you're, commonly on the receiving end of a particular kind of gift other than cash, you might want to consider whether to cover that as a specific example in your policy. And then also, as mentioned, you'll want the policy to be reviewed regularly to ensure that you reflect any updates in legal requirements that might arise, or new guidance from CRA or otherwise. And while we recognize that not all healthcare charities have separate foundations, if you are a foundation associated with a hospital or vice versa, it'll be important to ensure coordination and alignment between the policies of those two organizations, particularly with respect to naming, for example, which will obviously impact the hospital or the healthcare institution that's going to be exhibiting those naming requirements. And then you'll also want to consider, like any policy that a board approves, the oversight for that policy. So, do you have an appropriate committee who could be responsible for making recommendations to the board or reviewing the policy regularly? Similarly, is there a particular officer who, staff could turn to or who would have oversight over that particular policy? And then also perhaps identifying where it might be appropriate to refer to external advisors. Can you go to the next slide, please, Joyce? So one topic that has come up in our experience with respect to gift agreements is that a lot of charities are looking for ways to simplify or shorten their agreements. And so you'll want your gift agreements to align with your policy. So if you state that something is your requirement or a condition in your policy, you'll want that reflected in your template agreements. You may consider having a form of agreement attached to the policy so that you ensure it gets updated, consistent with your policy. Another approach that we're seeing is charities incorporating their policies by reference into their gift agreements. Like with other forms of agreements, there's different ways to incorporate a policy by reference. You could attach it. You could, contemplate that it's provided separately. You might even have the signatory also sign off on that policy. We would caution with respect to including a link to the policy to think about what your expectations are in terms of enforceability, either with respect to ensuring that, it's acknowledged that the terms of that policy apply, but also in terms of any future changes. we would caution, or at least, turn your mind to, or have your legal counsel specifically consider how they're drafting if you expect that any changes to that policy would apply, particularly if it relates to a material provision or something that's not expressly contemplated, that could be varied within the agreement. And also, it should be clear that, I'm speaking generally and from primarily an Ontario perspective. In other provinces, particularly we know in Quebec with respect to contracts of adhesion, there's also additional considerations that you'll want to look at before relying on incorporating a policy by reference in any form of agreement. And you may find, although it's tempting to rely on your templates, there may be circumstances where, given the conditions of a gift or other considerations, you'll want something that's more nuanced the scenario, and that's where you may consider, the benefit of the gift or the value of the gift versus the costs of getting that advice and developing that agreement for that gift. Can you go to the next slide, please, Joyce? So lawyers love due diligence, and a couple of people have mentioned different forms of due diligence in their presentation. So I'll be speaking with respect to due diligence specific to accepting a gift, and what due diligence a charity might want to undertake prior to accepting a gift. And you might outline the procedures for that within your gift acceptance policy, which will allow staff to apply it consistently and ensuring that they're conducting all of the due diligence that the charity has determined are appropriate to manage risks applicable to the specific type of gift, the type of donor, etc. This would be particularly important for a large gift, a non-cash gift, a gift with terms attached, or other particular types of gifts that might attract certain liability. So real estate's been mentioned a few times. I'll mention it later in my presentation, but that's an example of something that might attach additional liability and require additional searches and other forms of due diligence. So you could conduct due diligence on the gift itself or on the donor. So, for example, you might conduct a litigation search or a PPSA search against the donor to check for any encumbrances and to confirm ownership of that gift. With respect to the donor, if they're, a high-profile donor, subject to whatever confidentiality obligations you might be obliged to adhere to, you might want to speak with other organizations who have worked with that donor to see, what their experience has been, or to gather any other relevant information. Depending on, again, the nature of the gift or the potential for a broad impact or naming rights, it might be appropriate to consult with stakeholders or your community to, determine if there's any concerns with respect to that proposed or those proposed conditions. And as discussed by Corina in her presentation, if a receipt's being issued for a non-cash gift, it has to reflect the fair market value of the gift, and that onus is on the charity. So that's something you'd want to consider, what are the potential issues in that area, or how are you going to go about doing so before you go too far down the road with respect to that gift. And this might also be an area where you might want to seek legal, tax, or accounting advice with respect to your plan to receive that gift. Joyce, can you go to the next slide, please? So Corina already gave, a few people have given some examples of different types of gifts, and Corina also touched on the public policy considerations, discriminatory conditions and other things you might want to consider with respect to different types of gifts. So in the next few slides, I'm going to discuss and outline a few different types of gifts and different considerations that might arise. But as mentioned, the extent to which you address these specifically in a policy will, depend on your resources to develop that policy and how useful you find those examples. And again, if there's certain gifts that are more common for your charity to receive, you might be more inclined to spend the resources and the time to develop a lengthier section of your policy addressing that specifically, while also providing more general principles that those reading the policy could refer to when, dealing with something that's not addressed in particular. So issues to consider are both legal and practical. So you might want to first just start with issue spotting. So what type of gifts might raise legal, reputational, or other risks, and then how the staff member or the person applying that policy might go about addressing them. Non-cash gifts in particular are going to require further consideration. So the policy might identify certain non-cash gifts that will or will not be accepted. So, for example, while many charities will accept publicly traded shares that can be easily converted to cash, private company shares raise more questions and potential issues. And so whenever a gift like that is proposed, a charity will want to get appropriate legal and tax advice before accepting such a gift. Charities should also consider the market for non-cash gifts and the consequences that could arise from holding that property should it not be possible to sell it, shortly after receiving it. And for less traditional gifts, so like cryptocurrency, as Corina had mentioned, other examples might be vehicles, art, or other properties. A charity might want to consider whether it's willing to incur the costs of due diligence to receive that type of gift, with respect to whether it be professional advice or then just the administration cost after receiving it to handle that type of gift. And so again, it might be a matter of if it's a gift that's often brought forward to the charity, that it's worth obtaining that advice and putting in place the administrative procedures to handle that type of gift. And then for other one-offs, the charity might decide that they're more inclined to ask the donor if they're willing to liquidate it, for example, or make some other arrangements prior to accepting a gift in that form. And then, as mentioned, determining whether the charity can issue a receipt will also be an important consideration. And so Corina had outlined a number of considerations to keep in mind in that respect. Next slide, please. So as I had mentioned, one area in particular that will warrant additional due diligence and something that you might want to address specifically in your policy would be different interests in real estate. So, for example, real estate can attract environmental liabilities, and it might be necessary in that case if you were to receive a gift of real estate to conduct environmental assessments or have an expert involved prior to accepting that gift. Depending on the nature of a property, again, I had mentioned if you're not able to liquidate it immediately, you might also need to consider whether a charity can actually hold that property or whether holding such property could constitute a business. And then if so, a related business. So there's additional considerations that would need and analyses that would need to be undertaken for that type of gift. And another consideration that, and again, this is where perhaps your gift acceptance policy cross-references other policies, but both Terry and Theresa presented on or referred to the disbursement quota in their presentations, and it'll be relevant to consider whether accepting a certain type of gift, particularly non-cash, how that will impact your disbursement quota. And then with respect to donor restricted gifts, so Jacqueline will present in more detail on donor advised funds. And I think she'll mention donor restrictions in her presentation, but they may legally limit how a gift can be used. So a charity will need to give consideration before agreeing to such conditions if those conditions could expose the charity to legal, financial, or reputational risk. So from a legal or reputational side, that's where considerations like potentially discriminatory conditions as Corina had mentioned, could be relevant. And then from, a financial or practical side, how those conditions are going to be monitored and put in place and adhered to. And so from this perspective, the charity might, using that cost benefit analysis, decide what size of gift would warrant agreeing to such conditions. And also the charity would want to consider, whether adhering to those conditions might impact its mission, vision, values, and its ability to adhere to its charitable purposes. Next slide, please. So as I've mentioned a few times, sort of a guiding set of principles or something that you might want to refer to in your gift acceptance policy or remind the staff who will be working with your policy about are the charity's charitable purposes and their mission, vision, and values. So if a gift or the characteristics of a donor are inconsistent with the purposes or the mission, vision, or values of the charity, that might be a basis on which your policy would contemplate that the gift might be declined or, otherwise might get escalated for further review. So an example that I was able to find is in 2020, the BBC reported that a UK organization refused to accept a gift from a rapper who had previous convictions for violent offenses and also offenses including children, and it was a children's charity. So it was a proposed cash gift, but they made a statement that it's their policy to decline funding from donors whose activities don't align with the mission and values of the charity. So that's an example where a charity might choose to decline a gift because it deems that associating itself with that donor isn't in the best interest or consistent with the purpose or the mission and vision and values of the charity. And so this is where your policy, again, might be specific, but is more likely to be some general principles that will guide those applying the policy for situations as, Corina mentioned, values evolve, or of course, unanticipated situations might arise. Next slide, please. So there are circumstances, as I've mentioned, where your policy might contemplate declining a gift. So it could be because of the gift itself or the restrictions that are sought by the donor in respect of that gift. It may also be because the donor or the gift doesn't comply with your purposes or your mission, vision, or values, as mentioned. It might be the case that it can't be accepted in a manner that complies with the law, or doing so would be too costly or onerous or otherwise risky for the charity. Or there could be other legal, policy, or reputational risks that you might determine aren't acceptable in exchange for that gift. And it'll be important in that case, for staff to be supported with the communication tools that they can use in that circumstance, and also, how that's communicated to the donor. And consideration might be given to whether your policy will provide for mandatory approvals in that circumstance. So, for example, if declining a gift of a certain side might get escalated to the board or some other authority for approval or communication. Can you go to the next slide, please, Joyce? And then sort of one additional area of consideration in particular with respect to your gift acceptance policy, and in many cases, this is dealt with in a separate policy. And as mentioned, of course, it'll be relevant. The institution or hospital policy will be relevant in this regard, but where you're going to grant any form of public donor recognition or naming rights, particular reference will want to be made to due diligence processes and ensuring that any risks or primarily reputational are considered before such rights are granted. And then also you'll want to give consideration to any restrictions on the rights. For example, is the naming for the life of the asset? Is it for a particular duration of time? Are there circumstances in which the name of an asset that is the subject of a naming right can be changed? And there also might be circumstances where a donor has made a pledge, over time, and you'll want to consider at what stage the naming right is actually made available. So is it when you've received 50% of the gift, or 75%, or 25%? And this is another area where, and Corina touched on this example as well, of the Sackler family. So in reading the coverage of that situation, where there's a number of institutions that had assets or wings or buildings named after the family. In several instances where organizations had removed the name, a number of them cited it as being pursuant to their usual procedures or pursuant to their naming policy, which I think puts the charity in a bit less of an uncomfortable or gray area than having to rely, on their particular arrangement with that donor if they have a standard practice that, naming rights expire after a certain amount of time, or that there's a trigger within their policy or their usual procedures that they can rely on. And it, again, provides them with the consistency and the transparency in that situation. And there's also other organizations that have stated that while they'll no longer accept gifts from that family, they aren't able to change the name of the particular building or wing because of perpetuity clauses within their agreements. So something to consider, to be cautious of when granting such rights. And again, an area where your policy might prescribe a higher threshold of approval or something getting escalated to the board of directors before such a right would be granted. So I'm a little early on my time, but that's the end of my formal remarks. So if there's any questions, or I'm sure Terry can jump back in on some of the great questions on his presentation.
Oh, Sophie, you underestimate the interest here. We have questions for you. The first one is, won't take you long to answer. You referenced including policies within agreements and possibly doing them through electronic means. So the question is, would you recommend that if you do so, you refer to a specific version of the policy or a specific date of the policy?
Yeah, so that gets into obviously the question as to whether you contemplate that any subsequent changes to the policy would be incorporated by reference into your agreement. But if you're fine with that not being the case, and that would be our recommendation, that it either be attached or that you be more clear about what terms you're referring to specifically, then yes, that would be one way to show specifically the terms that the parties turn their minds to. So if there was ever a dispute as to what the terms of the agreement were, if it's acknowledged that it was version 2 effective February 2023, and that version was linked, and the more you can show that the donor turned their minds to those terms and they were presented in front of them and those were the terms the parties agreed to, the more likely they are to be enforceable.
Very good, thank you. Another question was, if you were dealing with a charity that doesn't yet have a gift acceptance policy, what would you recommend as the starting point?
So as I had mentioned, there's no one size fits all in this circumstance. They seem to come in various lengths and complexity and topics. One thing that, as a healthcare charity, there's a large network of healthcare charities. It can often be helpful to turn to your peers. So that's one thing I would suggest. But then beyond that, I think you want to consider what are the general principles you're already following, and start with trying to document your existing practices. And then perhaps it might be appropriate, whether it's someone in-house or externally, to obtain legal and tax advice about particular key principles that you'll want reflected in that policy. So those would be places that I would suggest starting.
Very good. And the final question was a question about whether there are any restrictions for hospitals on their ability to name buildings or other parts of their complex.
Yeah, so this was one that occurred to me when we are talking about healthcare in particular. So there was previously a more restrictive naming directive for, business names and corporate names. So maybe less so in the case of a particular, a smaller wing or a particular part of a hospital. But with respect to the corporate name and the business name, there was previously a requirement for Ministry of Health approval that was changed to just a notification, a set of standards that a hospital is accepted or expected to adhere to, including a notification to the ministry. Although then now under the ONCA provisions, hospitals have to have their articles of amendment approved by the Ministry of Health. So in that circumstance, if a hospital were to rename themselves after a donor, that would go in front of the ministry in any event. So there's no longer a naming directive that requires approval, or even I think it previously prohibited naming the corporation or adopting a business name to reflect a donor. That's no longer the case, but there is still an expectation, I believe, of notification. That was the change in the expectations.
Okay, very good. Thank you. Okay, we are a bit ahead, but I think we'll proceed with our next topic. And then if there's a little time at the end, we can see if there are any leftover questions for some of the other speakers. So when Corina spoke earlier, she talked about the need for a gift to be a full unqualified gift in order for a receipt to be given. And yet we know that our donors do like to weigh in on the use of the donated funds. And so for this next talk, Jacqueline Demczur is going to talk to us about donor advised funds for healthcare charities. And Jacqueline is a charities and not-for-profit lawyer at Carter's. So Jacqueline, over to you.
Great. Thank you, Lynne. Hello, everyone. It's a pleasure to be with you today. And as Lynne mentioned, I'm going to be speaking to you about donor-advised funds and their possible use by healthcare charities. So I could have the first slide, Joyce. So in terms of introductory comments, there continues to be considerable interest in donor-advised funds throughout the charitable sector. And given this, healthcare charities, if they don't already offer donor-advised funds to their donors, may want to consider utilizing these DAFs, that's what we call them for short, as giving vehicles to add to their arsenal of fundraising tools. You need to do your homework first to determine whether donor advised funds is an area that you want to delve into. But if so, it's important that you understand what they are at law, their current issues, and that you set them up properly and manage them properly from the outset with your donors. In the presentation today, we're going to cover 4 main topics, talking about what DAFs are and why they're so popular, what a DAFT is at law, including recent case law, survey some current issues related to DAFs, and we've covered some of them already in the earlier presentations, but I will highlight how those particular issues relate to DAFs specifically, and some practical considerations when you're working with donor advised funds. I wrote a paper in 2019 on the topic of donor advised funds. I updated it in May of 2023. So if you want more information about anything that I talk about today regarding DAFs, you can take a look at that paper available on our website. Have the next slide, please. So let's talk first about what a donor advised fund is. Now, it's a type of charitable giving vehicle. It's established when a fund is set up by a donor by making an initial donation to a registered charity. And we're going to call those charities that hold donor advised funds DAFT holding charities. The fund that's set up by the donor, its capital and or its income, depending on that fund's particular terms, is then used by the DAFT holding charity to make gifts over to other registered charities, including healthcare charities. So a number of your charities may receive from time to time gifts that come from a DAFT holding charity based on the advice that those donors provide to the DAFT holding charity. So the gifts that come from the donor, usually it's a single person or a family, come into the donor advised fund. And once they come into the fund held by the charity, they're irrevocable and they become the property of the DAFT holding charity, and receipts are issued for those gifts back to the donors. The DAFT holding charity then holds, manages, invests the monies in the donor advised fund, and then will periodically gift amounts from that donor advised fund, either from capital or from income, depending on the DAFT's terms. And those gifts go over to qualified donees, that includes registered charities, or now they can also go to grantee organizations, subject to the new qualifying disbursement rules that Terry talked to you about earlier today. Where you have a DAFT holding charity that's in the healthcare related field, then the gifts from the DAFTs that they hold could possibly be directed on donor advice over to different healthcare charities in the sector, or possibly even to different program areas within a dedicated healthcare charity beneficiary. Next slide, please. So what I just described up to now could cover traditional endowment funds, traditional restricted type funds, but with a DAFT, there's an extra feature that those traditional types of charitable funds don't have. And in a donor advised fund, the donor is given the unique role of being able to make periodic and ongoing non-binding suggestions to the DAFT holding charity regarding the distribution of assets that come from the DAFT over to qualified donees or grantee organizations. But it's important to remember that despite the ability of the donor to provide this ongoing advice to the DAFT holding charity, all administrative, operational governance decisions related to the DAFT are the sole responsibility of the DAFT holding charity. And that's because the monies that are, the assets that are in the DAFT are the property of the charity alone, not the donor. The donor's already made their gifts over to the charity, gotten their receipt. They can provide advice, but that property isn't theirs anymore. It's that of the charity. So the charity alone is responsible for its management. And failure by a DAFT holding charity to properly hold and maintain donor advised funds in compliance with both tax and trust law can obviously be a problem for the charity, result in potential liability, including breach of trust allegations, as well as credibility in the sector and eroding of donor confidence in the charity. So you want to make sure that you're handling DAFs properly if you're going to take on this type of vehicle. Next slide, please. So why are DAFs so popular now? Well, they're popular because they're a practical as well as appealing alternative for donors who don't themselves have the ability, the interest, or the time to operate their own private charitable foundations. It's relatively inexpensive to establish a donor advised fund within a DAFT holding charity, as opposed to setting up and then operating your own private charitable foundation. You'll see at the bottom of this slide that some DAFT holding charities don't even have minimum initial donations, or they can be as low as $5,000. Some are obviously higher, but there's a lot out there where the minimum amount that you contribute to set up your donor advised fund is relatively small. You compare that to private family charitable foundations, and unless they're set up to do flow-through donations over to qualified donees, you likely want to have a minimum asset base of $1 million to $2 million, and then have enough income that's generated from that asset base to both make gifts to qualified donees and cover your annual expenses. Another advantage of donor advised funds, and we'll talk about this more later in the presentation, is that they provide anonymity to the donors who use donor advised funds within DAF charities and more flexibility in their structuring. Next slide, please. So we'll talk about donor advised funds in a little more detail, specifically the types of gifts that can be made over to a donor advised fund and then how they're used going forward. First off, the donors are going to make charitable gifts to their donor advised funds. And Corina spent some time explaining what the common law definition is of a charitable gift. It has to be a voluntary transfer of property owned by a donor over to a donee. This is the DAF holding charity, for which the donor receives no consideration. Now, in addition to making this voluntary transfer of property over to a charity, the donor could also impose donor restrictions on the gift. They don't have to. It can come in as an unrestricted gift, which means the gift is just used through the DAF for the DAF holding charity's own charitable purposes that the charity themselves decide. Or the donor can impose restrictions on those gifts, which limit how the DAF holding charity can use that gift in the future. They may limit how the gifts are used to make gifts over to charities in a particular charitable area, like healthcare or the arts. Or they can restrict the types of activities that can be carried on with those gifts. Perhaps they're only to be used for capital projects, for the purchase of equipment, or a particular area of care within healthcare. And then those gifts will be gifts most likely for income tax purposes, provided that all the Income Tax Act's requirements are satisfied. And then if that's the case, then those gifts from the donor into the DAF can be receipted by the DAF holding charity. If I can go to the next slide, please. So let's just dive a little bit deeper into how donor advised funds work. The original gift from the donor sets up their own family or their own personal donor advised fund within a DAF holding charity. And they can make those gifts on an unrestricted basis, or at the time of setting up the donor advised funds, the donor can request and the charity can agree to certain restrictions on the use of the DAFs. How long that capital is to be held. Perhaps the gifts come in and they'll be held on a perpetual basis, and only income is used to make gifts over to qualified donees and grantee organizations. Or there could be restrictions on how the income is to be used, or both. Then we have that extra added feature of the donor advice that is able to be provided by the donors on an ongoing basis. That advice that the donors can provide can relate to a number of aspects related to the management and administration of the DAF, but usually the advice is restricted on to what type of charities the gifts are made from the DAF. Usually the donor advice is sought and provided on an annual basis, but it could be more frequent depending on the specific fund agreement's terms between the donor and the DAF holding charity. But it's important to remember, though, that just because the donor can provide advice, it doesn't impose a legal obligation on the charity to act as the donor directs. Rather, it's more of a moral obligation for the charity to consider all of these donors' suggestions and make a determination on whether they will make the type of gift the donor suggests, or they can decide not to, depending on the circumstances. Next slide, please. Because of that, this donor advice is not binding on the DAF holding charity, that the DAF holding charity makes the final decisions because the DAFs are their property. It's important that this is clearly explained to donors from the outset, and that their advice, input, suggestions, or advisory, this final decision-making is in the hands of the charity itself. And this is important to do to make sure that all the donations by donors to DAFs are true gifts at law and then able to be properly receipted. Because the DAFs are the charity's own charitable property, they must exercise ongoing direction and control over all aspects of that property. The concern here is that if there's excessive ongoing control by the donor over the gifted property in a DAFT, it could lead to the CRA considering the gift to be a directed gift, and this could then lead it to be defeated or negated. This causes issues, obviously, with receipting. Corina touched on this in her presentation. And so you want to avoid being in these situations where there's any issue with the receipts that are being issued over to your donors, and not exercising, your charity not exercising direction and control over the donor advised funds. Next slide, please. So our understanding of what a donor advised fund is at law has been confirmed in a case from 2 years ago. The details are on the slide here. It involved the Joseph Lebovic Charitable Foundation. And that foundation had set up a donor advised fund within the Jewish Foundation of Greater Toronto. And the decision confirmed, the Superior Court confirmed that while a donor is free to make recommendations to a DAFT holding charity on how the monies in their DAFT are to be granted out to registered charities, the DAFT holding charity is under no obligation to follow those recommendations. So in this particular case, the donor had set up a DAFT with the Jewish Foundation. His brother assumed responsibility as the fund advisor of that DAFT following the original donor's death. And a dispute arose between the parties on how monies were to be spent from that DAFT on gifts to qualified donees. The brother brought a motion to prevent the Jewish Foundation from spending funds from the DAFT in a manner that was contrary to his requests. And the court found that he lacked the grounds for his motion. And they stated that unless restrictions are imposed by the donor at the time that the gifts are made to the DAFT when it was originally set up, the donors aren't able later to direct how monies from the DAFT are to be spent by the DAFT holding charity. So if I can have the next slide, I'm going to look now at some current issues that are associated with DAFTs. There's 10 of them I'm going to cover. Some of them have been discussed in a little bit more detail by our earlier speakers, but I can highlight some of them here. The first is that there's an ongoing perception in the sector and in the broader society that assets that are held in donor advised funds are somehow languishing. And this concern was raised in the 2019 report of the Special Senate Committee on the Charitable Sector. Specifically in relation to DAFTs, they said that consideration needed to be given by the regulators to means of ensuring that donations don't languish in donor advised funds, but are instead used to fund charitable activities in a timely fashion. Now, some in Canada have criticized this recommendation as conflating DAFTs as they operate here with certain features of DAFTs in the United States. And the DAFTs in the United States are a different type of vehicle and can be used as loopholes for private foundations to avoid minimum payout requirements. If I can have the next slide. In Canada, though, we already have, the regulators have the tools to ensure that this languishing of assets in DAFTs doesn't happen. First, there's annual disbursement quota requirements. This is the minimum calculated amount that a registered charity is required to spend each year. Theresa explained very, very well how the disbursement quota requirements work. As well, there's inter-charity transfer rules, the anti-avoidance rules that Theresa mentioned in her presentation, and they prohibit transfers between non-arm's length charities for the purpose of avoiding minimum payout obligations. So given the tools that are already in the arsenal of the regulator here in Canada, it's not entirely clear why there's ongoing concerns about DAFTs having languishing assets. By way of comparison, more traditional types of charitable funds like endowments or other restricted funds also provide their donors with immediate tax benefits through donation receipts in exchange for their gifts, while the asset distribution from those endowments and restricted funds takes place over time. So it's very similar the way that the donor advised funds work, but they don't have the same level of criticism in the area of languishing assets. Next slide, please. So the second issue that may have an impact or will have an impact on donor advised funds deals with the disbursement quota, specifically the increase in the disbursement quota requirements that have been in place for taxation years after January 1st, 2023. Theresa covered a lot of this, so I won't spend a lot of time on it, but it's important in the context of DAFTs and DAFT holding charities to understand that their DQ obligations in any given year are calculated on a global basis based on all of the assets that they hold. It's not done on a specific DAF by DAF, individual fund by individual fund basis. Now, there's some in the sector who have questioned or are raised for consideration whether a disbursement quota requirement should be imposed on individual donor-advised funds in order to make sure that each individual DAF is dispersing sufficient income. But that's not in place now. Theresa talked about this, so I won't spend a lot of time on it, but the increase in the disbursement quota requirement could be a challenge for DAF holding charities, as well as any charities with a lot of endowments or other restricted funds, particularly where those restrictions deal with how capital can be expended. It may be necessary for those charities, if they can't generate enough income and aren't able to expend their capital, to get court orders to get the appropriate authorization to do so in order to meet their disbursement quota obligations. Next slide, please. Looking specifically at donor-advised funds, there was a good research report done in 2023, but in conjunction with the Canadian Association of Gift Planners. And that report indicated that there's only about 10% of DAFs in Canada that hold assets over $1 million. So if we go back to this idea of imposing a disbursement quota requirement at an individual DAF level, not the current way, which is on a global calculation basis, it could be that a DAF holding charity that has a number of DAFs under $1 million might have and would be subject to the 3.5% disbursement quota rate, would actually have a lower disbursement quota requirement than if it had assets over $1 million. So you'll look here from the research report, the average granting rate from DAFs in 2021 was 9.8% of their assets in a year, which is well in excess of the 5% disbursement quota now in place for amounts over $1 million. And there are many DAF holding charities, whether they're community foundations or other dedicated DAF holding charities, that impose their own internal disbursement quota requirements on each of the DAF funds within their charitable property. I'm going to move on now, if I can have the next slide, to some changes that have happened to the annual charity information return filed by registered charities called the T3010. Theresa touched on this in her presentation, but in January of this year, CRA released version 24, and it reflects some anticipated changes set out in the budget from a couple years ago, 2022, which were aimed at improving collection of information from charities on their investments, as well as on the donor-advised funds that they hold. You'll see there's two versions in effect now. Version 2024 is to be used by charities that have a fiscal period ending on or after December 31st, 2023. The number of changes in version 2024, and some of the earlier speakers talked about those changes, but in relation to donor-advised funds, what you need to know is that there's now a new set of questions for charities who hold donor-advised funds. They need to provide 4 different areas of information now to the CRA. You have to provide the number of donor-advised funds that they held at the end of the fiscal period, the total value of those donor-advised funds, total value of donations received by those DAFs during the fiscal period, and then the total amount of qualifying disbursements made from the DAFs during the fiscal period. And those qualifying disbursements include both gifts to qualified donees and now grants over to grantee organizations under the new qualifying disbursement regime. Also some DQ-related questions that Theresa had explained in more detail earlier, and references to qualifying disbursements have now been added into the T3010. If I can have the next slide, please. So one thing that Terry spoke to us about today in great detail was qualifying disbursements, this ability now for registered charities to be able to make gifts or grants over to grantee organizations. You need to satisfy a number of the requirements. They're set here out on the slide. But the important thing for DAF holding charities to be aware of is they have to always go back to their charitable purposes to know whether this is an option now available to them. Where a DAFT holding charity has the sole charitable purpose of making gifts over to qualified donees, then they don't have the proper purposes in order to carry out qualifying disbursements under this new regime. Instead, if this is of interest to them, if they want to have the ability to make gifts or grants over to non-qualified donees, they'll need to amend their purposes to put new active purposes in place, whether it's to, in the case of healthcare charities, support, promote health and support research and other areas related to health, or environment or the arts, or whatever particular area they want to provide gifts to non-qualified donees under. Have the next slide, please. Terry also discussed the anti-directed giving provisions that have been put into the Income Tax Act that are related back to qualifying disbursements. There's some concern about what the term implicitly conditional means in the context of anti-directed giving. In the context of donor-advised funds, is it a problem if a donation is made to a DAFT by a donor, followed by a request that the gift be made from the DAFT over to a non-qualifying donee as a qualifying disbursement? It's not entirely clear. We'd hope for some clarity on this issue, or more clarity on this issue in CRA's final guidance that hasn't come. So it's something that needs to be monitored and carefully reviewed with your legal counsel if you're interested in making qualifying disbursements involving donor-advised funds. Next slide, please. Another area to bring to your attention are some proposed changes to the alternative minimum tax regime. Budget 2023 proposed some changes to the AMT. And if you're not already aware, the AMT is an alternative method to calculate income tax liability for high-income individuals. And the purpose of it is that those individuals will pay a higher tax than they would pay under the regular tax rules. And those changes were to take effect for tax years after 2023. You'll see on the slide two main areas where proposed changes were being made to the AMT. One of them was 30% of capital gains on donations of publicly listed securities are to be included in the AMT. Currently, there's no inclusion of the capital gains, as well as 50% of donation tax credits, among others, cannot be used to reduce the AMT payable by high-income individuals. Now, those are proposed changes. In August of 2023, legislation came out from the government to implement these changes, but concerns have been raised by stakeholders throughout the consultation process. And to date, the proposals remain under development. They haven't been put into legislation yet. It may be coming soon. Everyone's waiting to see what will happen, but that's something for you to be aware of, because if these changes come into effect, they could impact high net worth donors' giving patterns. Usually there are significant donations made to DAFs as well as to charities more generally following special events such as property or business sales by a high income individual. So if we can go to the next slide, please. In the last year or two, there have been some concerns about some changes made to the Income Tax Act and whether it might trigger the need for charities to file what are called T3s, tax returns related to the internal trusts that they held within their charity. It had been CRA's long-standing administrative policy not to require charities to obtain either separate charitable status for their internal trusts or to file separate tax returns. Finally, CRA sort of put this issue to bed when they confirmed on November 10th, 2023, that registered charities, including DAFT holding charities, aren't required to file T3s for their internal trusts. Instead, information about all aspects of charities and their charitable property, including DAFTs, will be filed through the T3010. Next slide, please. It will be important if you're interested in putting a donor-advised fund program in place to ensure that the gifts that are coming from the donor-advised funds over to qualified donees are not offside of the Income Tax Act, because this could result in complaints, audits, penalties, or sanctions. Some DAFT holding charities place limitations on the type of qualified donees that are able to receive gifts from their DAFs. Sometimes it's religious, sometimes it's geographic in the context of a community foundation. But you want to make sure that all of these restrictions are clearly communicated to your donors, either in the gift agreements themselves that set up the DAFs or in a separate granting policy or guidelines that you want to cross-reference over into your DAFT agreements. You also want to make clear in that granting policy that gifts that are made from the DAFs can't result in any private benefit back to the donor who set up the DAFT or their family, such as making gifts from the DAFT over to a hospital or a hospital foundation and directing that they be used to buy tickets or for fundraising events that the family may be attending. That's just one example. There's many. It's not enough, though, just to have a granting policy. There has to be ongoing monitoring and enforcement of that policy and its terms by the DAFT holding charity. Next slide, please. Another unique feature of donor-advised funds is, in addition to the donor being able to provide advice on an ongoing basis about gifts to be made from the DAFs, there also is the ability for that donor to appoint successor fund advisors. Some DAFT holding charities like that option, others don't as much. Where the DAFT agreement's silent, then it's possible that a donor's attorney under a power of attorney or their executor, if they were to pass away, would be able to take on the role of the successor fund advisor. So you'll see on this slide, because I'm starting to run out of time, some of the issues that you might want to address or at least discuss with your donors in relation to the appointment of fund advisors and successor fund advisors. Next slide, please. And the last issue to bring to your attention deals with the impact of anonymous donations from DAFs. So one thing that a lot of donors like about a donor-advised fund within a DAFT holding charity is that they can remain anonymous when gifts are made from their DAFT over to qualified donees, including registered charities. That they just keep their privacy maintained. They don't have to deal with ongoing solicitations from various recipient charities. On the flip side, recipient charities of gifts from DAFs don't really like this anonymity associated with donor-advised funds. One, they can't simply even say thank you to the donors for those gifts, and they can't keep the donors advised of the effectiveness of the gifts that came from their donor-advised funds. So there's some advantages and disadvantages depending on your perspective. Next slide, please. So I'll close because we're almost out of time for today with just some practical advice. If your healthcare charity either works with DAFs now or is thinking about implementing this as one of your new fundraising tools, you want to do your homework first. You want to carefully understand what DAFs are, how they work, and how they need to be managed correctly under trust and tax law. You want to create template gift acceptance and granting policies to deal with the management of your DAFs. And you want to have template agreements that you use with your donors that set out different options in relation to the donor advised feature of those gift agreements. You want make sure your charity runs the process, not the donor or their legal counsel. And you want to utilize consistent procedures as you enter into gift agreements with donors, as you administer those DAFs on an ongoing basis and solicit or receive advice from the donor advisors on those funds. The next slide, please. And you want to be vigilant. You want to make sure in your communications with your donors, both conversations with them on your website and your fundraising literature and in the agreements themselves, you want to avoid language that suggests that the DAFs belong to the donors, that the donors are clients of your charity with accounts with your charity, that the DAFT is the donor's own private foundation. Lots of flexibility, lots of advantages with donor-advised funds, but they're not a private family foundation of the donor. They're your charity's assets. So just to close, DAFs represent opportunities for healthcare charities and other charities to have ongoing connection and engagement with their donors. And they could be a new way for your charities to attract more gifts and potentially larger ones on an ongoing basis from donors. Donors really like the flexibility of DAFs. But you need to be mindful that there's additional administrative work associated with donor-advised funds. And I have some charities when I say, is this something that you're interested in because it's popular? And they're not interested in it because they simply don't have the staff that's able to work with donors on an ongoing basis to obtain and then consider and then possibly implement their advice on an ongoing basis. So some pros and cons, but it is a very popular, interesting vehicle that lots of charities are exploring and utilizing at this time. So I thank you for your comments, thank you for your interest, and happy to answer any questions in the last few minutes we have.
Thank you, Jackie, very much. So we do have a couple of questions for you. One relates to the recognition that a DAF contribution can make. Can they recognize the name of the underlying donor when they make their contribution to another charity?
Yes, they can. Usually at the time that the donor advised fund is set up, or you can do it on an ongoing basis when you provide annual advice. You can indicate whether you want to be anonymous, whether you want to have your name disclosed or the name of your family disclosed to the recipient charities. There's a fair amount of flexibility there.
Very good. Great. Another question we had relates to transferring a DAF. Can you transfer it from one holding charity to another DAF holding charity? And can the original donor be the one who makes that direction?
Right. So once the donor advised fund is set up in a charity, the charity is the trustee of that fund. And there may be circumstances where that charity can no longer hold and administer the fund. They can resign as the trustee and appoint a new registered charity to be the new trustee of the fund. And there's a process set out in the Trustee Act to make that change over and transfer over of the fund. The new trustee has to accept the fund according to its restricted terms as set out in the original gift agreement. They essentially step into the shoes of the original charity, and they have to administer the fund and respect its restricted purpose terms going forward. The donor can't initiate that process because the donor advised fund isn't their property anymore. However, you could, if you think this is a possibility, at least set out in the agreement the right for the donor to at least be advised if there's going to be a transfer of the fund, possibly be consulted, but they don't get final decision-making authority and they can't make that change of trustee happen.
Very good. Thank you so much. All right. This has been really, I learned a lot, and I hope that the people who are watching us have learned a lot as well. I'm going to turn this over now to Terry for some final closing remarks.
Well, thanks very much, Lynn. And we're going to end on time in about 30 seconds. But just to make sure that we tried to answer as many questions as possible, I ran out of time. So a question that came in refers to qualifying disbursements and being able to incur expenses associated with it, which is permitted by CRA. But the question is, does that then permit what about the expenses, the administrative expenses, which a grantee would have in receiving a grant? And there's nothing in the guidance that addresses that issue. Maybe in the future they want to, but you go back to the Income Tax Act, and it does indicate that a qualifying disbursement, it requires the charity to, quote, ensure the disbursement is exclusively applied to charitable activities in furtherance of the charitable purpose of the charity. So I would suggest that the administrative expenses associated with the particular activity or program is okay, but just trying to do general expenses, backroom expenses of the recipient is not going to meet the Income Tax Act requirements. So with that, we've done our very best to respond to as many questions as possible. I want to thank Joyce Ning for helping out the Fasken's team in putting together the webinar. Thank you. And for the IT team at Fasken's. I want to thank as well Lynne. Lynne and I have worked together in putting this webinar together for you. So thank you, Lynne, for your leadership and for co-moderating the program today. We hope to do this again, and if you have any suggestions of what would be good topics, practical topics in the area of healthcare philanthropy, please keep us in mind. Joyce has indicated that the PowerPoint slides will be available in the next few days, so they'll be sent out to you. And as well, there will be a questionnaire as usual. And so hopefully you'll say, well, the questions were great and the answers were wonderful. And that would be great to see. So thank you very much for being patient and sticking with us right through to the end. And I hope everyone has a wonderful day. Thank you for joining the webinar today on behalf of both of our firms. Thank you.